Okay. Again, good afternoon, or I guess good morning if you're not in the Eastern time zone. Welcome. I'm so glad you could join National Housing Rehabilitation Association for our 2020 virtual asset management conference. I'm Tom Amder, and it's my pleasure to serve as the president of NH&RA. I was thinking about just how strange and challenging these times have been for our country and, of course, for the affordable housing community. And it's just reflecting. I've just been so incredibly proud to work with all of you on the line today. You committed professionals that have chosen to dedicate your careers to serving the needs of low and moderate income Americans at a time when obviously people's needs in that community are very great. I've been just so impressed at how resilient our community has been during these very trying circumstances. And based on just numerous conversations I've had with affordable housing professionals from around the country, one of the conclusions that I've made is that the asset management professionals in particular have really played a pivotal role in our rapid response to this crisis. Oftentimes, bridging divides between departments, filling staffing gaps, leveraging new technology and systems, sometimes on the fly to enhance business processes under the quarantine. Um, you've been reprioritizing resources where necessary and facilitating constant communications between, let's face it, at times some very nervous partners. And I just wanted to express my thank you and respect for the hard work that you're doing. Of course, we would have preferred to be meeting today in person. In fact, we did have an in-person asset management conference scheduled a few weeks ago in Denver. But obviously, we're hosting the event today and tomorrow virtually because though we can't get together in person, now more than ever, it's really important to share strategies on how to adjust to the change that we're all experiencing, how to continue to mitigate risk and ensure owners' financial and mission objectives are being met. So again, thank you for what you do and for committing to grow together, although I guess technically today 6 feet plus apart with NH&RA. Now I'd like to introduce NH&RA's president, Holly Wiedemann, who's the founding principal and president of AU Associates, who will be making a few welcoming remarks. So Holly, take it away.
Thank you, Tom. And first of all, thanks to all of you for joining us for this first NH&RA Virtual Asset Management Conference. We're excited to have lots of people. Yesterday it was 360. Today it's 390 almost, perhaps, and in attendance, which is a record number for our regular asset management conferences. The word regular is really not applicable these days. We are living in a world that is anything but. Between the COVID pandemic, the crippled economy, record unemployment, and the racial unrest across the world, we're on the forefront of a brave new world, the likes of which we can't yet imagine. What we do know is that a host of things will change: how we do business, how we work, how we live, and how we play. We know that the world changed after 9/11, and it will likely change more as we navigate these times. What is foundationally good is that the affordable housing industry has been dedicated since its inception to have positive impacts within the communities we serve. There are lots of easier ways to earn a paycheck, as we all know, than what we do. We are serving the most vulnerable, and yet we can always do better. Tom Amdur and his team at NH&RA have put together an outstanding conference that will provide usable information that will assist you and your teams in addressing a host of issues that we're all tackling. For those of you who have participated in the town halls, you know that you've had the front row seat, albeit virtually, to the top minds in our industry. While we have many members with us today, we also have those who are not members yet. So I urge you, because you clearly recognize the value of NH&RA, I urge you and your organization to become members. The value of this organization, to me, is a learning ground for the exchange of ideas in our complex field. It is the ability to connect with other professionals, to network, to learn, and to share. I know that I have developed lifelong friendships over the decades, and they're both professional and personal. I also know that if I have a question, there are a host of accomplished people who can answer it. So welcome. Let's enjoy these sessions. And I know that I will look forward when hindsight is 2020 and we can all be together again. Thank you.
Thank you very much, Holly. So many of the relationships that I've made in this business, and I know many people on the line have been at our in-person events. And it's, while very gratifying to have so many of you joining us virtually, we certainly miss getting together in person. It's an important way to exchange information, form new business relationships. And frankly, from NH&RA's perspective, it's a big part of our funding resources that allow us to do all of our advocacy and mission-driven activity. While this makes it for a little bit of a difficult year, obviously from that perspective, fortunately, we're incredibly grateful to have so many sponsors that have come step forward to support NH&RA during our time of need, to support our organization when we need the most, and also at a time when I think we collectively need these types of forums and exchange the most. So I wanted to take a moment to thank all of our sponsors for the event. Starting with Bank of America, they are our presenting sponsor for all of our 2020 events. Thank you very much, Bank of America. ProLink Solutions will be sponsoring our opening roundtable in a few minutes. Connor Strong and Buckaloo will be sponsoring our insurance roundtable tomorrow morning. MRI Software, which is our media patron, as well as the HII Group, which is a conference book sponsor. And we've gotten a lot of editorial support as well from Tax Credit Advisor magazine. If you have accessed your virtual conference book, which I hope you have already, you'll see a sample of some of the great asset management content that we have routinely throughout that fine magazine. And I encourage you to absolutely check that out if you're not a subscriber. I think you'll get a lot of actionable and useful resources out of our magazine. We have got a fantastic program planned for you over the next 2 days. We'll be kicking off our event with a roundtable discussion in just a few minutes with some leading executives from around the country on how they are creating value and navigating these challenging times through their asset management and portfolio management functions. This roundtable will be followed, by a discussion that will be focused on facilitating more productive conversations and relationships between general partners and limited partners. We are really excited to have a keynote address by the great David A. Smith following that. And then we'll be wrapping up with a virtual reception today using the Zoom meeting breakouts at the end of the day. And we'll be using those breakouts to have some smaller scale discussions based on some themes that we surveyed our attendees about. And I'd encourage you all to go into the chat at some point now or later on during the meeting. There will be a survey link there, if it's not already there, that will allow you to RSVP to which breakout that you would like to participate in later today. And I think that'll be a really valuable resource and will help you connect with more people. Tomorrow morning, we have a pre-conference session hosted by ProLink Solutions that will be demoing how they're using technology in their asset management software to improve asset management, followed up by some technical asset management discussions on the insurance marketplace, on managing relationships and contracts with your third-party property managers, and a hot topic session to close out the day that is really going to be focused on creating a game plan for distressed assets. So a lot of really great discussion over the next 2 days. I'd like to take just a couple of minutes now to do a couple of quick polls, just so everybody on the line can get a sense of who else is joining them for the meeting. So I'm going to be launching our first poll now, and I'm just going to take kind of 30 seconds for each of these polls. So if you wouldn't mind just clicking on this real quick. I'm going to give you a couple of second warning in a minute, and we'll just go through the results. So just bear with us for the next, 10 seconds or so. All right, 5-second warning to the closing of the poll. All right, here we go. All right, so as has been the case with a lot of our previous events, as a developers organization, I'm not especially surprised on this, but obviously a lot of general partner developer participation today. Pleased to have so many syndicator and investors, as well as our housing finance agency partners as well. And obviously we can't do much of our work without our lawyers, accountants, and consultants. And given the number of other responses, next time I launch one of these, I'm going to have some more options for folks. All right, now we're going to go quickly on to poll number 2. Within your respective organizations, let's see here, if you could just let us know what your particular role is. And again, we'll just take 15 or 20 seconds to give you all a chance to fill this out. It's really fun for me to see the results come in live, although you guys can't see them, but it's really interesting to see. All right, I'm going to end this poll and share the results again. So perhaps not a big surprise, heavy density of asset managers and portfolio managers for our asset management conference. But again, a substantial number of others as well. So we'll have to expand our polling options next time around. And now I'm going to just launch our final poll in the welcome and introductions. And this is really just about kind of your job title within your organization. So again, we'll take another 10 seconds or so. Okay, I'm going to close out this poll and share the results. And as you can see, again, we've got a real diverse level of participation from all the whole spectrum of people's respective organizations. So again, welcome all. We're so glad to have you here. We'll be doing some more polling throughout the event, but I'm going to go over now just a couple of call it technical advice for the meeting, so you have a good experience, and then we'll get started on our opening panel. So we are going to try to make this as interactive as possible, given the constraints of the virtual environment. So that to that end, we want to encourage people to ask questions along the way. You'll see in your Zoom toolbar there is a Q&A box. And if you want to plug your questions in there, that will be shared with all the panelists, and we will try to get to as many of them as possible live during the meetings or after the fact. Next, there is also a chat function if you want to share any thoughts with the panel or the broader audience along the way. And you can plug questions in there as well if you want. And we're also going to try to take some live questions along the way. So if you want to use the raise your hand function in your toolbar, we will try to take some live questions too. Would still be helpful for us if you could plug your question into the Q&A box though, so we know when to slot you in and when it's an appropriate time for, during the discussion. As I mentioned a few minutes ago, again in the chat box, if you could RSVP for the breakouts during the virtual reception later today, we will get you all sorted out and into the right discussion group. And then the last bit of technical announcement I guess I'd like to share is there is a second screen experience for this event. We are using our conference app, and many of you may be familiar with it from our in-person meetings. You should have received links to download that app yesterday in your confirmation email. And if you're having trouble with that, just feel free to chat us or email us, and we can help you troubleshoot that along the way. But the app has a lot of nice features on it. It contains the full attendee list, of course, and it gives you the ability to chat people within the app. All the session materials will be available through the app. Obviously, the agenda. We may be making some announcements if there's any schedule changes or last-minute updates that we need to share. It works best on your tablet or phone, and you can download it from your app store if you haven't done so already. There is a web version as well, and I believe that link was shared in yesterday's confirmation email, although I just wanted to warn people it does not have the full functionality of the smartphone version. So it will be a better experience if you use the phone or tablet version of it. And since we are running a little into our opening session, I'm going to transition us right over. So if our fellow panelists can please turn on their video screens, I'm going to start doing our introduction for the opening panel. First thing I wanted to do was, before I introduce our panelists, is again thank ProLink Solutions for sponsoring this opening roundtable. For those of you who don't know, ProLink Solutions is one of the premier providers of affordable housing software for our industry. You may already be familiar with their software products that they've developed for housing finance agencies and investors. And I know many of you that have attended this event in the past have participated in their focus group meetings, so you probably will be familiar with them as a result. But before we start our opening discussion, we'd like to share with you a short video message from ProLink Solutions. So Brooke, if you can cue that up.
Looking for cloud-based solutions? There are a lot of options out there on the market. How's that working for you? Dealing with folders, channels? We say no. In Procorum, we have work centers. What are work centers? Think about a deal room. We created Procorum work centers thinking about our industry, affordable housing. For real estate developers, for property managers, for bankers, syndicators, investors, and for government agencies. Stay connected in the cloud. Have a new asset? Create a new work center and add to your asset management portfolio. And invite internal and external parties to collaborate. Through files, posts, tasks, and calendar. By ProLink Solutions.
Wonderful. And again, thank you very much, ProLink Solutions, for supporting this event. And we encourage everybody to dial in tomorrow morning to join us for the product demo. All are welcome. And now on to our panel. As you guys know, oops, I just lost my notes. Let's get back here. There we go. NH&RA is a multidisciplinary organization, but at the hub of the wheel, so to speak anyway, are affordable housing developers. And I always like to kick off our events with a developers roundtable to really set the stage, raise the issues, and provide context for the technical discussion that we'll be exploring throughout the program. And our panelists today will be sharing a lot of the experience they've had steering their respective organizations through, let's face it, what are uncharted waters, and where they're seeing challenges and opportunities, particularly within their asset management and portfolio management divisions. So I'm joined here today by Bobby Custer, who's the Director of Asset Management over at Foundation Housing, which was formerly known as National Foundation for Affordable Housing Solutions, Incorporated. I can see why they shortened the name. That's a mouthful. But he joined Foundation Housing in 2012 after serving on the real estate team at Cohn-Resnick. And in his role as the Asset Management Director, develops and implements asset management practices, financial reporting, oversight of the third-party property managements, operating budgets, compliance with debt and equity regulatory requirements, underwriting data, and a whole lot of other stuff. So it's a full plate Bobby has. Next, we have Brent Rustin, who's a partner and senior vice president at Dominium, which is one of the largest owners and developers of affordable housing in the country, with a portfolio, I believe, of 36,000 plus units today. Brent provides oversight of the dispositions, market rate acquisitions, and refinancings of those assets, as well as quality control of the owned portfolio. And I actually didn't realize this until I reread Brent's bio this morning, but he joined Dominium in 1984, eventually running its property management company, before he left for a stint in a multifamily consulting practice, and then rejoining the firm again in 2008. So he's been on all sides of the equation. And finally, we are joined by Carolyn Berry, who is a managing partner and managing director of asset management at the Jonathan Rose Companies, for which she joined in 2007. In addition to overseeing the firm's asset management for its East Coast portfolio, she's also led a lot of the firm's sustainability efforts, which is how I first, I believe, got to know Carolyn, including implementations of their green retrofits of their existing portfolio nationally, and the development of a LEED Gold certified residential development adjacent to the Stanford Transportation Center, which I Googled the pictures of, and it's a stunning looking project. So a lot of great experience here from some of the most sophisticated operations in the business. And how we'd like to kind of kick off the discussion is just to give each panelist a quick minute or two to fill in any gaps I might have left in your introductions, maybe highlighting sort of your overall portfolio focus and your asset management function. So Carolyn, let's start with you.
Sure. I think for the purposes of today's discussion, it'll be helpful for me to explain our portfolio. So it's a nationwide portfolio spanning all the way from Boston to California, and from it all the way down to Atlanta. It is a mixed income portfolio. We have a lot of Section 8 housing. We have quite a bit of LIHTC that we've developed ourselves. And then we do have just a couple high-end luxury products. So it spans the gamut, with the majority of it being affordable housing. We are very focused, obviously, on financial performance, as any asset management team would be. But the environmental impact and social impact teams are considered part of asset management, so that we can be assured that while we're also meeting our social and environmental goals. That's really important to us, and that's really played a very important role during this pandemic, which I'm sure I'll speak to as we move through today's conference.
Thanks, Carolyn. Brent, how about you go next?
Sure. You know, I love these because I always feel like I'm on the Brady Bunch panel. I can point to people. Thanks for having me. My name is Brent Rust. I'm a partner and senior vice president. And Tom reminded me how long I've been doing this. 1984 is a long, long time ago. Hopefully I'm not wearing the same suits that I wore in 1984 anymore. And given the pandemic, I'm not wearing a lot of suits these days because I'm working at home. Dominium's a really interesting organization. I love being associated with it. We were at about 36,000 units. I've recently sold a few, but we're adding some more. So we're kind of in that range. Our portfolio is almost exclusively in the affordable arena. We do LIHTC housing, Section 42 housing. We do some workforce housing. We don't have anything in the what I would call high-end luxury market. We've got some B+ class, A- class types of assets that we built a few years ago. But our geography is very diverse. We're in 22 different states. We're based in Minneapolis, Minnesota, so we have a large Minnesota presence, but we also have our largest presence in Texas and in Florida. And both of those markets are relatively new for us in the last, I'll say, 10 years. We were more Midwest based, and I see us in the future migrating somewhat farther south as we're doing new things. We've got a lot of new construction taking place right now. Acquisitions, not as much. And we also are, we're selling a fair number of deals that we had already planned on selling prior to the more recent events. So it was kind of pre-programmed. Our average deal has been with us, I think, about 22 years. So we are very much long-term owners of housing. That's kind of us in a nutshell.
Thanks, Brent. And Bobby, do you want to give us a quick overview on foundation housing? Oh, you're muted, Bobby.
There we go. Thanks for the heads up there, Tom. we're based out of Rockville, Maryland, or North Bethesda, as they're calling it these days, depending on where you land on the pike. We're a nationwide portfolio, around 112 assets spanning, like Carolyn mentioned. We're also sort of Boston to California, a lot of places in between, more geographically clustered than evenly split. We've got a lot of presence in the Southeast, big presence along the mid-Atlantic seaboard, and then some out in Minnesota and some surrounding areas. We're growing out there. So 21 states plus the district, about 12,200 some units. And we're primarily Section 8. So most of our product is project-based Section 8. And sort of our modus operandi is acquired at that point and then use the Section 42 program to put a substantive rehab on it and preserve it for the next 10 to 15, 20 years. We've also done some deals where we were able to do some substantial rehab without that, just self-funding and financing the rehabs with conventional financing. So we are, exclusively third-party managed, which I know is slightly different than some of my peers here. But we've got about 8 different management agents that we work with. And again, they're mostly geographically clustered. So we don't typically have the same agents in the same market. Our California stuff is with one agent, Southeast is another, Mid-Atlantic is another, that sort of thing. We've seen, not as much on the transaction side from a disposition, but that's not really our move. We're a nonprofit whose mission is preservation. So we are long-term buyers and holders. We're always looking for new quality assets that we can help and do some good with.
Perfect. Thanks, Bobby. So first couple of questions for all of you are really going to be sort of the moment, our COVID-19 question. So I think a lot of us have been surprised at how resilient the affordable housing portfolio has been in terms of collections over the last couple of months. And, just real quickly, curious how things are going. We're at the middle of June now. How are collections going this month? And what do you think about kind of trending for the next few months? Anyone wants to take that, by all means.
I'm still unmuted, so I'll jump in and start. This was as I'm sure is a concern for everyone in the industry, was a big concern for us. And we had some ideas as we started seeing this coming of how it might impact us. But we felt we were in a good position with the high concentration of project-based Section 8 that we have, especially with a lot of our portfolio being elderly project-based Section 8. Those are folks who typically are on a fixed income stream that's not going to be impacted as much by this. So we were confident but still cautious, and we wanted to put in place some systems to really keep an eye on that and monitor it, especially with all the different forbearance options that were out there. We wanted to know if we were going to need to take use of those. But I've been, very happy to see that our original thoughts have panned out. We've seen strong collections throughout the portfolio, north of 95% almost every month. Ended last month at 97 for the portfolio. This month we're at 94 through Friday. I haven't put yesterday's collections in, but we're doing daily tracking certain weeks of the month, and then we scale it down to once or twice a week updates depending on what's going on with each set of portfolio or each set of properties and where they're at. If they're at 98, I no longer need a daily update, but it allows us to sort of pinpoint which properties to focus on and focus our efforts with management on those properties. Our Section 8 has outperformed our unassisted. So we do have some deals that are just straight LIHTC. There's no project-based subsidy. And as we suspected, those ones have had more collections issues than the project-based Section 8. But we ended up last month, I think 93% overall for those. But there's definitely some variability there, whereas the Section 8 is pretty tight on an average. Our unassisted spanned the gamut from 100% or 102, where they had some really good collections moves, and folks prepaying or paying past due balances, down to the high 80s and mid 80s. So
Carolyn and Brent, I'd like to get your perspective on that. And while you answer, I'm going to launch a related poll for the audience. So that'll be going on in the background. So Carolyn or Brent, are you having similar experience to Bobby's?
Yeah, I'd say our numbers are trending just as Bobby's are when he describes the difference between Section 8 and LIHTC. The only thing that I would add for what we're seeing this month is for the month of June, it's definitely trailing behind the other months. We had anticipated that would happen because our sense was individuals either have some money in the bank, or they're taking advantage of some of the stimulus funds, and that June, some of those sources might start to dry up. So June, I know we're only halfway through the month, and certain certain jurisdictions are allowing for late payments. So hopefully it'll get better by the end of June, but we're in the 80% area right now. It's hard for me to say the number. I mean, because we too are trending in previous months more at like 92%, factoring in LIHTC. But this month is not looking as good as previous months right now.
And Brent, what about you? And maybe the coda is, where do you see July and August if you have a crystal ball? And I'm going to share the results of the poll, which I think kind of reflect a little bit about what we've heard so far.
Yeah, I guess in keeping with Dominion fashion, we're going to be a little contrary. So, I got numbers as of the 14th. We're 89% collected for June rents, which is 1% above where we were at this time frame in May. And what's contrary in comparison to what both Bobby and Carolyn have stated, we probably have had a few more struggles with our Section 8 portfolio, our project-based Section 8. We believe the bulk of those issues have been associated with interim research having to be done. So in other words, we had anticipated receiving tenant portions, and those folks have come in and said, my job changed or my circumstances changed or whatever. So we have these kind of built up receivables that we most likely are going to receive. We will receive most likely, but they're not currently in. So that set our Section 8 portfolio back a little bit. Our senior portfolio has been, spectacular in terms of collections. Our family portfolio has been, kind of on average. Where we've struggled a little bit have been in some of our workforce locations, and those have been in particular, I think, relatively isolated. We've got a series of deals in Orlando, and Disney's been been talked about a lot in Orlando. However, we've had some strong collections at some of our assets, but we've had weaker collections at some of those assets, simply because we found out that resident base is really associated with a Disney or in that hospitality group right there. I think the receivables portion come July, August is probably our biggest concern. What's going to happen with eviction stays potentially lifting, things along those lines. I don't want to dwell on the bad actors that are out there that have taken us for a ride with things. We have a lot of folks that who really have struggled in order to be able to receive the subsidies that are available through the CARES Act and the stimulus payments. And those are very legitimate. They've lost their job. They haven't been able to receive those funds yet. And we'll work through those. But I think it's kind of come August that don't really know. I'm not really pessimistic, but not incredibly optimistic either. So, like so many things that have taken place during this whole last 3 months, you always answer these questions. It depends, and it does. It depends. What's going to take place in the next 30 days? Will there be more stimulus money going out to folks? What's going on with the social unrest that's taking place in the country, and will that have an impact on our industry and what's taking place. So it's all going to unfold in front of us, and it'll be a fascinating journey over the next few months.
Yeah, well, and I'll remind everybody, we all know this instinctively, that all markets are local, and the recovery will be different based on what state you're in, what city or county you're in, and what the regulations govern them, but also what's happening in the market, whether the entertainment, and hospitality industry is able to come back on a time frame, lots of other factors. So lot to try to unpack in that very difficult to answer question, I think. Let's talk a little bit about how your respective organizations pivoted, as the coronavirus really kind of took off about, 100 days ago or so. And I'm also kind of curious about how your response, now that we're into the 4th month, is evolving, and how you're how you redeployed and what you're thinking about doing next. And Carolyn, I'll let you take the first crack at this one.
Sure. As the pandemic was becoming our reality, we quickly formed a focus group within the organization that was fully focused on preparation and outreach and communication to our residents. And that has remained strong during this time. In terms of how we've redeployed since, at this point now we're focused on how to safely reopen and what can be reopened now versus what should we still remain very conservative about. So I would say, it takes up an incredible amount of our time. So we're working harder than ever, as I'm sure all of you are, because we still have to keep up with the normal course of business as well. Does that answer the question, Tom?
Yeah, I think so. And Brent or Bobby, I don't know if you want to add any, if you guys had a different sort of initial response. And
similar. We're a little smaller organization, so a lot of what we did was very similar, but on a smaller scale. As a company, we're probably 25 employees total. The asset management team, myself included, were 8. So we pretty much packed up and went home. Everybody took their laptops. We were fortunate that everyone was already equipped with laptops and for remote work. And there were certainly some hiccups of everyone setting up their remote offices, as you can see. This is an interesting place in my home, but we've made it work. From an operations standpoint, a lot of the pivot was at first was just how are we going to react? What can we do to keep people safe? And focusing on staff and residents and talking to our different agents. And that's where I found it was very helpful to have agents across the country. There were some who a lot of what they do is Washington, Oregon, California, and they were out in front, I think, in their response because it was in their backyards. It was happening on their properties. Whereas some of our other agents who are just, on the East Coast are looking at it going, well, that's happening over there and down on the cruise ship, but that hasn't hit yet. So we really benefited from being able to talk to all of our different agents and see what they were doing and say, hey, this is a really good practice you're doing over here. Let's send it out. And so that was, the gist of our response as a company was we implemented our remote work policy and cut our travel for our staff. But on the properties, it was gathering information from what our different agents were doing, going through that, looking at the guidance that was out there and brainstorming what responses should we be doing across the board, and then circulating that to all of the agents and saying, hey, here's a minimum of what I want you to do. And then here are some things that some people are doing because we recognize, like you mentioned, all markets are local, right? The response in LA and Sacramento needs to be different than the response in rural Pennsylvania, for example, where it hadn't really had an impact yet at that point. So we wanted to give the management agents the flexibility to do that, and also let them lead and let them know, we have some faith in you to make the right decisions on the ground, but at the bare minimum, need you to do X, Y, and Z. And then just staying in touch with them and seeing how that was going. And that was a lot of our response. And then we also shifted to like I mentioned, a strong focus on collections monitoring and doing daily updates and then scaling that back. And that's something that's evolved from, March, April, May, and now into June. I did want to add one thought to that, which was one of the things I saw, and this was pretty consistent with what was discussed on the town hall panel you guys had that talked about collections, was that especially on the LIHTC deals or the unsubsidized, there is some significant movement between the 10th and the end of the month. On the Section 8 deals, it's what you've got on the 10th or the 12th, whatever that sort of 2-week period is. Your HAP comes in, residents have had a little bit of time. But for the most part, that's what you're going to get. You might see some movement on the tenant side. But on our unsubsidized stuff, that's where really we could see the impact of management agents' focus or a particularly talented site team and best practices coming. I watched one of our properties go from probably 70% on the 10th to the 12th to ending the month at 101% because they collected all their rents for that month and they got a little of the prior month coming in, and that was focused by the management team and really persistent efforts by that site manager in connecting residents with local resources and constant contact and just following up and saying, hey, we're here to work with you, right? We're not trying to throw people out if we can avoid it. And we can't throw anybody out right now due to the eviction ban. So it's in our interest to work with people and say, hey, what can we do to come up with a reasonable payment plan? What resources are out there? Let's connect you with them. You don't have a scanner. Here's 4 places you can go and really put the information in front of them to help them get the assistance that ultimately helps us collect our rents and keep people in their homes.
So let's dig into that kind of theme a little bit more. And we actually have gotten a couple of questions that are sort of dig into this as well. So I'm going to take one of our prepared questions and modify a little bit. So listen. So I'm really curious what strategies everybody are really implementing to drive collections and, highlighting maybe the rural resident services and communications, with your residents are playing, as well as perhaps any technology that you might be utilizing to facilitate, timely payment, and what you might be doing to help folks in terms of getting signed up for services or resources, whether they're government programs or charitable institutions, and how your departments are helping with that. So there's a lot there, but
yeah, Tom, I'll jump in, and I do see the question in the chat, which I also really appreciate. So I'll touch upon that as well. Yes, initially part of our communication to the residents was reaching out directly. We created a schedule so that every resident got a phone call at least twice a week, and sometimes more than that. And that was initially to say, are you okay? Do you feel okay? Do you need food? Do you have your medication? And that was in combination with resident service coordinators, but also with our property managers. Well, that ultimately ended up translating into also questions about their financial stability, making residents aware of stimulus monies that were out there, but then also helping them if there was a constraint around paying the rent. So what started out as a social impact initiative ended up benefiting the property financially, because what we found is, individuals, they didn't want to leave their apartment and mail a check. We were able to get some people registered to pay online, for instance, or we sent someone to their door. They were okay, slipping an envelope through a door, for instance. So with those phone calls, we saw an uptick in rent payments thereafter. We also noticed that residents were tiring of the memos that were coming out. They were lengthy. They much preferred the phone calls, and it was a good way for us to interact. So.
Thanks, Carolyn. Brent, what are you guys doing in terms of coordinating better with the residents?
Sure, I think a lot of the similar comments, we tried to follow that. I'm really very proud of our management group and the efforts they put into it. It's been a lot of, well, you can't actually do this, but hand holding that would be socially unacceptable right now. But it's really getting people to understand what might be available to them in terms of financial assistance and trying to help guide them through that process. It was very frustrating, I know, for um, many of our communities because we have people that don't have internet access and they're waiting on the phone and they're waiting on the phone for hours to try and access funds that may assist them in trying to get their rent paid or other things paid. I think in a lot of ways, and I think a lot of people have discovered this, not just in the rental collection process, but in many ways, it's really forced both the resident and the management agent to interact even more. And there's been some wonderful interactions with that. Which I think just is going to build a stronger community as we go forward even more. So it's it's a lot of presence and a lot of people. If they have email in their email inbox, it's phone calls. We know a lot about folks right now and what's happening with them employment-wise and their financial condition, and we're trying to weigh all of those things and help them through it. Um, it's a tremendous amount of interaction and time that our management staff has had to put into it. But I think it pays off, not just for us and being able to collect rents, but I think it also shows the interest that we have as owners and management agents in making sure that we've got clean, decent, and safe housing there and going forward, and that we can maintain it.
Yeah. So one last sort of coronavirus question, and we'll get on to sort of more general asset management ones. Obviously, there's been a lot of temporary change that we're all experiencing, and we hope it'll be temporary. But I imagine that each of you have had some time to reflect now and are probably considering some structural changes based on the experiences you've had over the last several months. So I'm just curious if there are any major or minor things that you guys plan on doing differently within your departments or within your organizations generally, based on the experience we've had over, again, the last couple of months. So, have you embraced remote work? Are you like Twitter and telling your corporate staff, don't come back?
I think it's potentially dramatically changed our structure in some ways. We have about 800 people that work on site, and there are some differences that will happen there. We have about another, there's about another 800 people that are working on construction sites, new construction sites. That's probably not changing dramatically. But then we have about 250 people in our, what I'll call our corporate office, between accounting, development, more desk-oriented jobs, clearly. That is changing. And the idea of remote work is, I think, as an organization, we were somewhat hesitant to do some of that to the extent that we were forced to do when COVID hit. And quite honestly, I think we're really embracing it, and we see it more as of our future. And it also, the benefit to it is that it really expands our ability to hire people in different locations. No longer Minneapolis, Minnesota, it's a great town, don't get me wrong, I love it, but not a lot of people love it in January or February, and it's made recruiting a little difficult too. So the more that we embrace the remote work and people being able to do that, the wider the employment base we have. We were able to track productivity from our corporate staff in terms of everybody working remotely. It was spectacular, the amount of productivity that came out. So I think there's a fundamental change in our corporate office that we'll see the effects of for years to come.
Yeah, I want to add to that. So yes, I agree that it very much widens the talent pool that we can be pulling from. We have corporate offices in both New York City and in Cleveland, Ohio. So it is helpful to be able to recruit outside of those areas, particularly when you have a nationwide portfolio. but I wanted to add a different take on it too, and also address the rest of Kim's question from the chat, which is, how does one handle when you've got a corporate office working from home, but you're expecting your essential workers to be in the field? We have an affiliate property management firm. So what we did in that case was we increased pay for that period of time by $5 an hour for those individuals who are at the site, in gratitude of them doing it. The other thing too that we did was, knowing that work orders and units were on pause, we felt confident that we could stagger our workforce so that we covered weekends, so that we were also cleaning on weekends, but that it also allowed for some of our janitorial staff to work from home at times. And while they were working at home, we had them working on online training, for instance, so that they didn't feel that the corporate offices were all comfortable at home while they were just in the field, normal course of business. That was really important to us from an equity standpoint. That's not, long-term sustainable, but I think it was really important at the time. And in terms of our level of confidence in the team maintaining the asset during that time, individuals were so appreciative of the gratitude pay. We were not intending this effect, but what we found was that people wanted to be at the asset because they really liked that $5 an hour bump when they were at the property. So if they were working at home, they were getting the normal pay, but if they were in the field, it was a bump up of $5. So we actually had to encourage some people to work from home, because we said, guys, there has to be social distancing. You shouldn't all be there at the same time. So we knew that the assets were being cleaned. I mean, they care for our residents. We want to make sure that's the case. We did do Zoom meetings between asset management and property management, which were helpful, but it's never the same as walking through your asset. So last week, with some reopening in New York City, I went to 2 of our assets that I was particularly curious about, knowing that they had always been challenged in certain areas. And you got to see things firsthand so often. And then secondly, I have never had the property staff express a happiness to see me like they did, because usually, we're walking through and we're asking a lot of questions, but, they had been in the field for 3 months with nobody really coming in from corporate offices. So being able to slowly ramp up in a way that's comfortable for everybody, maintaining social distancing, wearing one's mask, it just builds so much morale. And I'm hoping that builds for longer term relationships between our offices and our field staff.
Interesting. Bobby, do you have a different take on that? And you're muted, Bobby.
Sorry about that. I got so into listening that I forgot to unmute myself here. As far as the maintaining the physical asset, we haven't done anything different than what's already being discussed. One of the areas where we're shifting our focus right now is, when everyone sort of moved to a work from home setting in the corporate office and everything sort of started shutting down, it was a lot of focusing on the immediate needs and what has to be done next and what are the biggest risks that we need to be tackling. Now we're shifting more towards okay, we've responded to that. Now what? Now what do you do? Like, you've got all of your, what I refer to as the day job stuff that hasn't gone away, right? Your financial reporting, your regular stuff, that's all still there. And you're trying to do that in challenging circumstances. But now we've got to sort of pivot and look to the future and say, okay, we shut everything down. Now how do you open back up? How do you do that thoughtfully and carefully? And so we haven't started site visits yet, but that's something that I know we're having some preliminary internal discussions about, very preliminarily. And I'm, talking to some of our agents about how do we stagger the openings back up and ramp it up so that we don't make folks uncomfortable, that we're all of a sudden you're going from nothing to 100, and all of a sudden people are in your unit all the time. And how we can thoughtfully do that. So I think, one of the things we're talking about is ways to survey residents and sort of inventory what's out there. We've been accumulating work orders this time, saying, hey, call it in, and if it's an emergency, we'll dispatch somebody, but if it's not, we're going to put it on this list. But I think it's also important to recognize that some folks aren't going to do that, and some folks may have done that at the beginning of April, but now things have just started to pile up, and they're feeling overwhelmed and don't want to do it. So, we're talking about different ways that we can survey residents, either via email or dropping off paper surveys, or a combination of both, or a phone call, and just sort of saying, hey, here's a checklist, and almost like a move-in, move-out inspection, or like a pre-react inspection, tailoring it to say, all right, what are the most important issues? What are some things that we want you to look at in your unit and tell us about that maybe we don't need to do today, but definitely need to be out on the next level, and gathering that information and then prioritizing from there how we're going to go into units and do things. Because I think one of the big issues we're going to have is, as things start to open up, there's going to be a big backlog of work that needs to be done, both the regular preventative maintenance that, may have been suspended, as well as things that, you only notice by doing, right? Like Carolyn said, you've got to be there to see it. You got to see things with your own eyes. And sometimes residents aren't going to see things because they see it too much, and they just accept that that's how it is in a unit. And you've got to have a maintenance person or a site staff in that unit to say, hey, that's not okay, or hey, let's open this up. That something sounds wrong. Let's find an issue before it gets worse, but that may be existing, they haven't reported. So surveying folks through a variety of methods, prioritizing. Certain agents have more technology at their disposal, I think. There's one who I've seen back in March and beginning of April was rolling out a work order system that when things were entered would drop down their screening questions. And so every time somebody called in, you're asking screening questions. And every time a maintenance employee went to a unit, they're asking screening questions, and that's logged in the work order system. And if anybody gives a certain answer, you just say, all right, you're on the follow-up list, and the system automatically says, boop, move that to the bottom. And in 2 weeks, it pops up a reminder that says, you got to call unit 204, see if they're feeling better, because 2 weeks ago they reported this issue. So, it's been interesting from my perspective to see some of the variety that's out there and see what people can be doing from that perspective, and then try to translate that across the breadth of our management agent partners to say, all right, maybe you can't do that exact thing, but what can you do that's similar? What can we implement on your sites to help get to that same goal, which is we've got to get back in units at some point, and we've got to be doing the maintenance, some of the little things that might have been deferred. Because you can only focus on, obviously everyone's focused their staffs on the janitorial side and the disinfecting regularly, but we've been looking at, let's get these exterior projects and the site projects, the grounds work, I hope everybody's mulch is very fresh and all your trees are trimmed and all those sorts of things are taken care of, because you've had some time there. But that's where I think we need to spend some time as an industry thinking about how do we reopen, right? Because it's going to be different in every locality. And that's something that I'm always curious to hear what our all the peers at NH&RA are doing, and learn from everyone else there.
Yeah, so let's pivot to the to how do we reopen and how we're moving forward. So y'all adopted your project budgets last December, not anticipating a global pandemic, and obviously your portfolios are all performing differently as a result. Some for reasons that you described already, like the increase in cleaning expenses, the Carolyn talking about sort of the hazard pay for people on site. As you look at sort of through the first quarter and project out for the rest of the year, there's obviously lots of things that you haven't incurred too, capital projects, and maybe some people have been furloughed along the way. I'm just kind of curious how the properties are performing over to the overall pro forma, and sort of how you're kind of rejiggering your plans for the year as things open back up.
Yeah, it was from our perspective, it was interesting. As soon as COVID hit kind of mid-March, we went into a mode that liquidity was very important to us, and cash flow was extremely important. And we in essence took our development staff and made them asset managers for a very, a quick and immediate and period of time, and they'll continue this. And I think we've gotten some great benefit. We actually we reforecasted all of our budgets and applied some toggles in terms of, because we had no idea what was going to happen with rents and things along those lines. So we've reforecasted budgets, and now that we have, we just got really May results out in the last kind of this week. We're going back and saying, how are we doing? You know, the saying I love the best is that real estate is operated the best and worst of times. And the converse of that is real estate is operated the worst and the best of times. We're having hard times right now, and things are really being operated very well. There's a lot of attention on detail. There's a lot of attention on really doing the right thing for our residents. These are times that really gel people together for a common cause. And I think, Tom, as you indicated, there is deferred in-unit maintenance that's going to come back, and we're going to have to deal with. There is this looming potential eviction problem that's out there, and we're going to have to deal with that, which is going to cause potentially a degree of vacancy, or even continue on the debate of more social unrest because of people's inability to pay rent. How is that going to affect our industry? There's a lot of unknowns yet that we are, you know, we're just going to have to see how they play out, and what does become available to our residents in terms of financial assistance. Are we going to have a second round of the virus? Is it going to get hard or soft, or is it going to be very geographically dispersed? So I think this is the time where my sense within our organization, my peers that I talk to, is that people are on their game, and they're really stepping up, and we are sharing more information as an industry than I think we ever have, and I think that's incredibly valuable. We've all become very transparent in terms of our collections and what's going on. And the sharing of best practices, if nothing else, that in itself will be a great asset for all of us going forward. So, you know, lots of changes yet to happen, lots of things yet to come. But there'll be good that comes out of this, not just the chaos that we've gone through. There will be a lot of good. And I think a lot of things that we don't know what we're going to have to deal with yet. You know, we're pretty secure as a business generally. It's not like we don't have customers. We've got more customers than we can all handle. But it's treating them well and treating them right, and maintaining the assets that it's really going to present some challenges for the operating side going forward.
Yeah, so all great points, Brent. I'm curious how, respectively, you guys are incorporating sort of the COVID variable into your budgeting, and as you're redoing your capital planning for the year, you know, some projects, exterior projects, as Bobby mentioned, you know, the landscaping, probably all those things are on track, and other things are far behind and may not be achievable in this year. And I'm just curious how you're adjusting to that. How are you measuring? How are you replanning?
So one thing that we've done is implemented new GL account codes with a lot of the properties, and just said, here's not many, but just here's one COVID expense account that if it's stuff that we're doing because of this that we didn't plan for, and you know, if this goes away, these costs potentially go away, put it down there, so that as we're doing our budgets for next year, I want to be able to quickly isolate that cost and sort of, like Brent mentioned, like a toggle, be able to say, hey, here's our budget if that doesn't happen, here's that budget if it does, and really be able to segregate those expenses from our normal ones. I think right now that's our primary response. We haven't I haven't seen a huge spike in a lot of spending overall, because I think there's definitely some canceling out. You know, you're spending much more on cleaning equipment and supplies and you know, janitorial services and things like that, but we are spending less on other things. So it certainly has gone up, but it hasn't been a something that is putting the properties on a bad footing. You know, it's sort of your normal fluctuations, and things are a little higher, but we're not breaking the bank there, which is good so far. I mean, I think if this continues and we really have to, if this continues and becomes a new normal, you know, if this isn't something that in 6 months there is, you know, we've been able to control it as a society, or, you know, in 18 months there's not a vaccine. If this is part of our new normal, then I think we absolutely are going to be looking at some structural changes for, you know, janitorial and cleaning contracts and services, because it's just going to be something that, you know, it's the new reality that you're going to operate in, you know.
Sure,
So-
and I was just going to add to that, Tom. So the biggest expense hit that we've seen to our budgets are related just to property insurance, right? And that's not necessarily pandemic driven. And I'm sure there's others on this call that are seeing the same thing. That's really our biggest challenge right now, is the cost of property insurance.
Sure. Yeah. And as I think everybody knows, we have a whole panel dedicated
A
to
very timely panel coming up.
tomorrow, which I think you'll find illuminating. So thinking about a couple of other things, one of the maybe rising tides that we have benefited from over the last couple of years has been the generally pretty good AMI increases in a lot of markets, which have facilitated rent growth. Obviously, we're in a different environment now, and you know, forgetting about what's going to happen to AMIs 2 years from now when they catch up with current income data. We did get a question from the audience, and it was one that we talked about. What are you guys doing or considering in terms of rent increases this year? Are you considering any? And I'm going to ask that of the audience too, in the form of a poll. So I will put it out to, I guess, Brent, you're unmuted. Are you considering, what's Dominium's thoughts on rent increases in the balance of 2020?
Sure. We started out and didn't do any rent increases across the entire portfolio, just to get a sense of what was taking place. We did provide for rent increases on new move-ins, so we were quoting, when new rents came out, we were quoting the new rent level on all new move-ins, and we started out not renewing at or renewing at existing rates. Since that time, and it's just been more recently, we have started to implement some level of rent increases in certain markets, and I think we'll kind of watch that as time goes by. Some locations haven't, statutorily, we haven't been able to do it, things along those lines, but we're watching it. We're going to try and be judicious in terms of bringing it out there. This is not the time to try and get the last nickel off the table by any means. So I guess I would agree with what seems to be your poll results, is we really haven't decided completely what it's going to be. It's too soon to tell, and I think we're in kind of that same mode. We're kind of watching it as time goes by, and don't think it's an all or nothing at this point.
We're handling it very similar to Brent, which is higher rent on new leases, not increasing current residents. It's more valuable to keep them in place and make sure they can pay the rent. And then we were going to reconsider in September what we were going to do through to the rest of the year.
And I'd imagine, Bobby, having largely a Section 8 portfolio, that's less of a decision point.
I will defer to my learned colleagues here for most of this. Yes, we've only got a handful of properties where that's even really a consideration, and so we're very much taking the, let's see what other properties in the area are doing, and if we're substantially over or under, it's something to investigate. But we're not. I like Brent's phrase. We're not trying to get the last nickel off the table today. This is time for that. It's way more important for us if we've got good tenants and units to keep them there. And that's really informed not just the asking rents, but also how we're handling late fees and collections and things like that. You can't charge late fees, but we're not charging them, but we're also talking to residents about, hey, if you've got a substantial balance, but you're able to make some payments, trying to incentivize them by offering to write off past late fees and things like that to get people current and say, if you're willing to work with us, we'd love to work with you. Our goal is to keep people in their homes and keep them happy in those homes, especially if they can't be evicted, so really just trying to focus on, as long as people are making good faith efforts and communicating and working with you there, working with them on those sorts of things. And yeah, now's not really the time unless you're wildly over or under to reset. We actually lowered some rents at one of our properties that was having leasing issues because we've been testing sort of where we were at over the past year, and we're having some struggles. And we looked at it and said, well, if we're having to offer concessions down to this level anyway, let's get rid of the concessions. Those are our new asking rents, and people respond. That's really that, and a very dedicated effort by the management team there has really paid some dividends in terms of getting those units leased up. Because I think people are, even though we might look at it and say, well, if it's $700 with $100 concession, it's still a net of $6. In people's head, $600 a month is a lot more affordable than $7 with a $100 concession. So if anything, we've moved slightly back on some properties.
So we've got about 5 minutes left, and we didn't quite get to all the questions I had outlined, but I want to try to get to a few of the audience questions. So we'll call this our rapid fire round. But this one happened to be on my list, so I'm going to ask it first, which is, with everyone staying home, are you seeing big increases in utilities like water and sewer? Anybody have any insight?
Not yet.
No,
We haven't
not
yet.
I think it could be coming, but we haven't seen it yet. And I saw one of the questions earlier was about impacts on your budgets going forward for next year and maintenance expenses. And I wanted to close that loop on what we had talked about before of, hey, I think there's a backlog of deferred stuff coming that at some point we're all going to have to work through. I think that's also going to be a key consideration when we're talking about budgets is, well, we may not have seen big overages yet, but it's because we haven't done all this work that's out there that needs doing. So I think the quarter after you start opening up is also going to be very telling in terms of budget impacts, because I would expect to see some significant spending there, either on supplies or if you have to bring in outside help to work through that backlog, depending on your staffing.
Another question here. Have any of your colleagues at your respective firms, perhaps on site or in the corporate office, come down with coronavirus? And if so, how have you handled it in terms of notice to other staff, closing down the office to clean, things along those lines? And I'm hoping the answer is no for everybody's sake, but.
No, we've had a few isolated cases, and we actually have closed an office or two for a 14-day stretch, and but it worked. It was the right thing to do. The resident population, was accepting of it. We were available, in essence, remotely from that site. Fortunately, we didn't have any large emergencies that took place, but it worked. And would that work now today? I think depending on location and what's going on in that particular community, whether people are maybe as thoughtful and forgiving as they were a month ago, I don't know. But we haven't had to deal with that. We've had a few isolated cases in our office, but it has not caused major disruption in our office. I've personally lost some friends to COVID. But it hasn't been through a work environment. So, the work environment has stayed relatively stable for us.
I'm sorry to hear that, Brent. It's hard. Well, I think we have time for one final question, and I like this one because it's a good wrap-up question. What keeps you up at night regarding asset management in your portfolio? So, what are you worried about today? You're focusing your attentions on.
For me, it would be the concern that there's going to be a long-standing economic impact from this pandemic, and that the residents who are sort of in the middle, right, the ones who are not in luxury apartments and the ones who don't have the benefit of Section 8 subsidies, so LIHTC, and those individuals, you know, who have historically held solid jobs, that they are going to be the ones who struggle the most in what it's going to take for them to rebound and get on solid footing. That's my single biggest concern right now.
Brent, what's on your?
I guess for me, it is there a round two? How big is that round two? That not only deals with the economic side, but the social side. And, you know, I think the thing that we didn't talk about much here, but is very apparent, is the current wave of social unrest seems to have something that is going to have some long-term effects. And again, I don't know what that is. I think it's good and it's healthy that a lot of these questions are coming up. I don't know that I really lose a lot of sleep over it, because I believe in, you know, all of our residents and everyone else, that we're going to come to realistic solutions to some of these issues. But it's not going to be without its level of pain and discomfort for all of us. Is round two going to happen? Are we going to have a vaccine? Those are the big things in my mind. We'll figure out the economics. It'll figure itself out. So those are the things that I guess I kind of think about more than anything else.
What about you, Bobby? Any closing thoughts?
If you're asking, do I have things that keep me up at night? I've got a whole host, but we don't have time for all that. And I don't think anybody came here for a therapy session. But just sort of riffing off of what my colleagues here said, it's a lot of the similar things. One of the things that really resonated with me was what Brent just said about the economics is going to get figured out, right? This is an industry full of very smart, talented, and dedicated people, and we'll figure that out. There may be some pain and some discomfort, and certainly there's a massive concern for what's going to happen to those folks on our properties, you know, who are living paycheck to paycheck and now haven't had these paychecks, and what's going to happen, you know, if you've got folks who end up being evicted in this tidal wave of evictions, if that happens at the end, where are they going to go, right? Like I do resident screening and I look for evictions for non-payment, and that's sometimes a disqualifying factor. And if everybody's doing that and you've got all these people, they've got to have somewhere to go. So we, you know, as an industry, we're going to have to think about how we deal with that. But one of the things that really resonated with me that Brent said was, I think about what is round two going to look like? Is this going to continue? And what's the impact, not just on housing, but on society? And one of the things that made me think of, and really looking at the news and where some of our management agents are, is how much we really depend on these individuals. And it's not necessarily, you know, it's really helped me, or really crystallized to me the fact that you've got to look at these relationships as, these are relationships between people. It's not your company and their company. It's your relationship with somebody there. And if something happens to those people, be it professionally or personally, that's going to impact what you do. You know, we had a scare where one of our management agents had somebody was diagnosed, or the spouse of one of their employees was diagnosed with COVID. And so they had to get tested, and they shut down their office for a period of time. And it was a little jarring to see how much we rely on them. And if something happens to them, you know, we've got some real exposure there. So I think it's helped crystallize the importance of those personal relationships and viewing everything, not taking that for granted, you know, calling people and saying, hey, I hope you're okay, and really meaning it, because you do hope they're okay, because you're depending on them, and there's nothing, you get to a point where there's nothing you can do beyond hope they're okay. There's certainly some things we can do, like talk to them about, hey, you're kind of behind the times on your technology. Let's talk about investing in remote work for your teams, because everybody else is already doing it. At some point, you're just hoping and praying that they're going to be okay, because you need them, and you develop those relationships. So I think that's where I would leave it is, we can't neglect the personal connections and the personal relationships and how important those are. And making sure you talk to people about that, because when you need people, when these times are tough, that matters. People's willingness to respond and think outside the box is really going to depend on those personal relationships.
Sure. Yeah, these are
And
obviously
invest in technology. That's the other big thing, is invest in the technology so that you can say, hey, it's a dangerous world. Everybody go work from home, and they can actually do it. That would be huge.
Yeah, I think we've all seen the value of technology, and there's a lot more that we can do in this space to make our businesses run more smoothly, improve our interactions with our residents, as Carolyn, highlighted earlier. I'll just throw in that, it's obviously a really important time to be empathetic. These are scary times between the economic fallout of the coronavirus, the health fallout of the coronavirus. I think it's no surprise that the civil action and civil engagement around the deaths of George Floyd and Ahmaud Arbery and Breonna Taylor and so many others have really been amplified right now because of the scariness of these times. And, we're on the front lines in our industry, and I think it's on all of us, as I'm sure everybody is already engaged, to do what they can and to start from a place of empathy, because, as you said, Bobby, we're not faceless individuals, and neither are our residents, neither are our employees. I mean, they're people struggling, and we should be the point to help. I want to thank Brent, Carolyn, and Bobby for sharing today. I thought this was a great panel, though I wish we'd been able to get to a couple more questions. We'll have to have like after hours to get to the ones we didn't get to. I want to thank ProLink Solutions again for sponsoring this session, and encourage everybody that's interested in learning more about their platform to dial in tomorrow morning at 11:30 Eastern. And we're going to take about a 10-minute break and then reconvene at 1:30 Eastern for our next session. So thank you very much. Get a glass of water, stretch your legs, and be back here in 10.
Thank you.
Thank you.
Thanks, folks.
All right, well, I am showing 1:30, so we're going to go ahead and get started with our next panel. And I invite our panelists to turn on their cameras. I'm Caitlin Snyder, and I'm the Policy Director here at NH&RA, and I have the pleasure of introducing our next panel on general partner and limited partner collaboration and communications. I know it's a bit of a mouthful, but we're hoping that we can really talk through how these two parties can communicate and how they're evolving their relationships in light of the coronavirus, which has really forced these relationships to evolve as both parties try to understand and plan for risks that are sometimes unknowable. Marianne Voda, who has been on the LP side of this equation for the last 25 years, is going to moderate our panel today. Marianne is a longtime NH&RA board member, and she brings a wealth of knowledge and experience to this discussion. I'm going to quickly introduce the rest of our panelists, and I encourage you all as attendees to check out their full bios on our conference app, and I believe a link to that will be coming shortly. So moving down in alphabetical order, Denise Carter is the Chief Portfolio Officer at the Pacific Companies, where she's responsible for long-term physical and financial viability of the firm's 180 plus operating properties. Greg Dobble is an Executive Vice President and the Director of Asset Management and President of R4 Servicer for R4 Capital. He's one of the 3 investment committee members at R4 Capital and has overseen all of R4 Capital investment closings since its inception. Christian Harriman is the Vice President at KeyBank, where she oversees tax credit investments in the Northeast region, as well as overseeing business investment portfolio. Brian Ivy is the Vice President of Finance at Conifer Realty, where he is responsible for the equity and conventional debt financing of Conifer's affordable housing developments and lead Conifer's financial closing and due diligence teams. And last but not least, we've got Dina Exfarias, who is the President of Affordable Housing, Senior Vice President for Ownership and Operations, and she's responsible for the oversight of POA's long-term ownership interests and its real estate portfolio, which consists of more than 11,000 units and $1 billion in asset value. So those are our panelist bios, and like I said, you can view them more on our conference app. And with that, I'll hand it over to Marianne to lead our conversation for the next hour or so. Marianne, over to you.
Thank you, Caitlin. And I want to just say that I'm very happy to be here today and moderating this panel of these really wonderful asset management professionals. We all know that open, honest communication is key to successful relationships, whether in our personal life or in our professional lives. It is key to building trust, and the communications between general partner and limited partner can really determine how a partnership will operate over its 17 years. Today, what we have decided to do is look at the life cycle of a deal and to really take segments of the, 3 segments of the life cycle. We have and talk about how communications goes between the asset managers on the general partner side and the limited partner side during the pre-construction or negotiation pre-construction, from the negotiation, pre-closing and closing part of a deal. Then we will move into the development phase and look at how communications both on a formal basis and an ad hoc basis works during that phase. And then we will move into the stabilized portion of a deal and talk about communications through dispositions. So that is the plan. And without further ado, I think we will start. And my first question goes to our direct investor, Kristen. I would like to know, Kristen, how much, if any, input does asset management at KeyBank have during the bidding negotiation phase of a deal? And if you are involved in any way, what are the issues that you focus on?
Sure. So at that stage of a deal, what asset management's role is to really look at the deal terms, the details, to see if we notice any pitfalls. Since we're looking at data portfolio-wide, we're able to look at specific details of one deal and see if there's potential delays or challenges that might arise simply because we've seen them before in another market or in another deal structure. So that's really where we're weighing in. For instance, if we're looking at our portfolio that's currently under construction and we notice in a market that there's a labor shortage for a particular trade, that's something that we're going to be mentioning to the rest of the deal team so that they can take that into account and perhaps, make certain that they have someone already lined up for that work, or if the schedule needs to be adjusted to kind of build in for a potential delay. As a deal gets further along through construction, if asset management has experienced that a particular state agency might be understaffed, and so there may be a delay in approving a cost cert or issuing 8609s, for instance, asset management's going to let the rest of the team know, and perhaps they might build in a bit more time between construction completion and perhaps conversion to permanent financing. So these are all items that asset management is going to be focused on, that they're going to be weighing in on, and just advising the rest of the deal team so that they're aware of the issues. We can take steps to mitigate those issues so that we can get the most accurate projections possible from day one. And as far as reporting goes during this time, we're definitely weighing in on what reporting requirements we're going to need to see during the life of a deal. And this is certainly the time where we'd be weighing in on that. I feel that the majority of the industry has, a pretty boilerplate clauses for what reporting they're going to need throughout the life of a deal. It's pretty standard. these days to see investors needing the same types of reports. So all of these are important pieces that asset management is weighing in now at this point. And really the goal is to make certain that we have a deal that we're certain, to the extent possible that anyone can be certain, especially in this environment, that the deal is going to perform the way we all anticipate it, we being all of the partners in the deal, the entire deal team. And the goal is really to eliminate as much uncertainty as possible, because as a deal progresses, we are tracking it against what we projected at closing, as is everyone else in the deal. And the more variances we can eliminate, the better for all parties.
Do you think that your general partner or the, who that you're negotiating with, or that your originator is negotiating with, understands your needs for these particular reports?
I do. If they've been in the industry and done several deals, then yes, I do. I think that it can be a common misconception that the reporting is just the reporting and all the investors need it, but they're not really doing anything with it. In fact, it is an essential part of what we're doing, because it does continue through the life of the deal. We are reporting out from an investor perspective, we are reporting out to a much larger organization. I think there's a challenge sometimes with partners to think that when you're interacting with asset management or a relationship manager, that you're dealing only with that person and not really recognizing that we're part of a much bigger organization. So the information we're getting, the information that we're reporting out, is being reported out to a much larger organization of which we are one piece. I think that may fall through the cracks sometimes. I believe you're still muted.
Marianne, you're on mute.
Okay, so I can understand how that happens. So I want to move on and just ask Greg, as a syndicator, do you find that, same questions, but is it any different for the syndicator than it is for the direct investor?
Sure. In general, I think, there's a lot of consistencies. We're also in certain deals representing, many hats, from investor standpoint. So different investors have different touch points. So you want to collectively over time take that together and, implement that into your thinking and evaluation of a property and partnership investment from the very get-go. I would say in general, a typical deal, the asset management team on the syndication or at our company, really gets a feel for a deal once a deal's, gets signed up, but really starts working on a deal maybe 30 to 45 days prior to closing. Reviewing property management, due diligence, reviewing development team information. Then, you kind of, transition into an investment committee mode where there's a deal package that's put in place. At our company, I sit on our investment committee. So, we make it a huge point that that I have, a voice in there, as well as, my team that, works throughout the country and manages these assets as soon as the deal closes. So asset management takes over. There's a transition, I think, as many of us know, from originations to asset management. So it's key that you try and mitigate any downfalls and pitfalls that can occur, from a transition from, an underwriting and origination standpoint to asset management. So, on the front end, you can be looking at a whole wide range of things. I like to focus a lot on, the deal economics, tax consequences. You need to understand, losses, credits, similar to what Kristen was, mentioning in terms of variances. You're trying to definitely avoid any type of variances because post-closing, that's going to be a headache that you have to deal with. So the more that you can, advocate and show how things have happened in different parts of the country with certain, agencies, with certain developers, how things have, in your experience as well as the team's experience, gone over time and show them real data. I think, the better, you have a stance in terms of trying to have an impact on how that deal is structured, at a closing standpoint. From a reporting aspect, I would agree, not many, reporting items end up being negotiated. It's pretty boiler, point in terms of what is required. I think there's a lot in the industry that understand that. So I think that ends up being a relatively easy conversation when people are asking for certain changes. It depends on the relationship as well. So
okay. Thank you. And I'm going to move over now to Dina and get the GP input on this. And before you start, one thing that both the investor and the syndicator mentioned is that most of the reporting items that are requested are boilerplate. And so my question to you is, do you feel that way? And then also, just what are the issues that you focused in on during this negotiation, pre-closing, closing time?
Sure. Thank you. I think, I guess I'll start from a general partner, owner, operator perspective. I think it's really easy, and I can like harken back and think to years back when we weren't really super involved on the acquisition side. I would say now we're maybe have swung to the other end of the continuum. And so for us, just this week I've read 2 LPAs for acquisition prospects and 1 LOI for an equity deal that we're signing up. And so why as a GP would we be looking at it that early on, not even kind of imminent to closing? And to me, sort of there are 4 reasons that we're doing that on our side. One of them is to influence the agreements, and getting at your question about boilerplate. There definitely are some like themes of the boilerplateness of it, but there's these subtleties that can manifest and can be problematic. So I think it's to influence the agreements, and I'll touch on a few examples of those. But the other kind of three reasons that we get involved now, and we're actively involved in reviewing the LOI as well as the LPA in the early stages before it's baked, not just inheriting it, is we, like Greg, in asset management, have a seat at the table relative to our investment committee and the decisions of what we're choosing to acquire and invest in. And so from an accountability standpoint, much like Greg was alluding to, or Kristen was, I don't want to sign up for something that I don't, feel strong about and on board about. So sort of influencing the agreement, seat at the table, accountability, and then standards and consistency. Despite there being some boilerplateness to them, there are subtleties throughout all of them. And so, we want to make sure that we're driving standards, and our development project managers are doing a deal or 2 or 3 every year or 2. And so, but they're not, privy to the 100+ partnership agreements that we have, or the 100+ right of first refusals we have. And so making sure that we're getting some consistency is important to us, because otherwise it becomes a management, nightmare. And then the last kind of like reason for it, in addition to the consistency and the influencing the agreements and seat at the table, is just there's all these, every deal you think that they're the same, but there is special considerations for all of them. Some of them need a loss flip provision because there's going to be a lot of negative capital account. Some of them, have an energy grant component or a state credit component. And so they're just, I like to think they're the same, and I always hope them to be, but they never end up being that way. And so for me, that's part of it, is why we're engaging at this stage and why we're finding tremendous value in doing so. The types of things that, we're looking at or seeing or making sure that have the tweaks and the adjustments that we need, are things like back-end provisions relative to the ROFR, and making sure that we can access, both the ROFR and the option. And a common thing that I see is it's going to the wrong person. And so in a partnership agreement, it's going, in the case of the option, it's going to the general partner when it can't go to the general partner because it will collapse the partnership if it's not 2 or more parties in a partnership. So things like that, where we're catching. Waterfall and residual split is obviously going to be very important. We're a preservation shop, and so we want to make sure that the back end and the waterfall are favorable to preserving the property and doing right by the property. Guarantees is another thing that we find it important to look at in terms of consistency, so that we're making sure we're signing up the same entity to be the guarantor and with consistent liquidity provisions and net worth provisions. Even reporting. So you would think like reporting would be boilerplate. But I saw an LPA today that had, a reporting deadline. And this is for a buy and hold transaction we're buying that's in like year 8, had a reporting deadline that we 100% can absolutely never meet. And so I don't love to start off a relationship, with Greg or equivalent peers in the industry failing to meet a requirement that they have. So I'd rather have that discussion up front and sort of say like, not sure the origin or the investor behind this transaction, but I can't meet the 10th of the month. I don't even get the information internally as of the 10th of the month. So I certainly can't give it to you then, or whatever be the date. And so I just like to set things up rightly and try and make some of these adjustments. The other reason that we're looking at these deals now is there's been all these tax law changes relative to, real property trader business elections and designated individuals. So for all of those reasons, we're just finding the need to look at them. And we're not finding that they actually are 100% boilerplate. And for 100% of the time I've looked at an LPA or a ROFR, 100% of the time I've been happy I have, and asset management has adjusted something.
So do you have the conversation, and do you have a conversation to understand why the limited partner is asking for a different deadline, and how does that conversation go? And do you feel like it would be beneficial to have a pre-closing conversation with your asset management counterpart on the LP side?
So yes, we have the conversation, and usually, hopefully our acquisitions team or development team that's kind of signing up our deal, oftentimes they'll hook me up with someone on the other side of the transaction, and we'll have a conversation, and we can usually, work out kind of the why from our shop and the why from their shop and find a mutual resolution. And sometimes something has been like promulgated or moved forward because it just is that way, but it doesn't have to be that way. And so I 100% support having a conversation. I usually always try and give context to my comments and try and make a good relationship. And I think that upfront discussion is very important. And just sending a bunch of comments without context as to the why is not going to be very helpful. So I would support a conference call and a discussion up front, absolutely.
Great. Okay, I'm going to move along because we need to do that, but thank you. On to the development and conversion segment of the life cycle. And I'm going to start with Denise. And Denise, from the general partner's perspective, what aspects of the development process do you feel could benefit from more or better communications? And do you think that the limited partner can understand and accommodate, or you found that they accommodate and understand your reasoning for occasional waivers to the partnership agreement during this period?
I mean, our everything has been dependent upon the relationships that we have. We've closed approximately 16 deals since February, all with syndicators we've previously worked with. And they've all understood the need to be somewhat flexible and to bake in language into the partnership agreements that will help get us through this kind of transitional period. We're also a contractor, so we're doing all of, we're building most of the deals that we've closed, and the need for just the flexibility. And as we're, converting these is, we're also in a period of leasing up some of these projects, and things are not obviously going as well as they were anticipated when we closed these deals a year and a half ago. And so I think we've found that just having those close working relationships with the syndicators that we work with has definitely made this easier. We've been transparent in what's going on our properties as far as what's happening from a construction standpoint. We're also mindful of the fact that we know that the syndicators we're working for, like R4, are responsible to their upper tier investors, and that they're asking certain questions and wanting certain performance milestones met. And, we're trying to just be mindful of the fact that not only are we trying to meet the needs of, getting these projects done in the cities that we're working with, but the investors and lenders that we're working with. And I think we've found that that's just being disclosive, and we're also learning too. So we're going back to the syndicators and to the LPs and saying this, we need to the next time look at something different. And, if we have that relationship, that they're more willing to come to the table and address that. But I think that the last 3 months have definitely shown us, having that relationship is key to making sure we, take care of them as well as take care of getting this project built, getting it converted, getting it leased up.
Greg, how do you at your syndication shop deal with ad hoc asks during the during the development phase of the deal?
In terms of from an investor?
Correct, representing the investor.
Yeah, we're constantly communicating with the development team, with developers. It's set up differently in certain circumstances, but as I think most of us know, there's contractor, owner, architects. The relationships there are, as well as construction consultants that are throughout the country working with you during this time, has been ever more important. Not only, for the investor and the syndicator, but also for the developer, the contractor, because, in order for the construction and rehabilitation to continue, an investor, generally requires a sign off from a third party in terms of the work. So we've had to shift the focus from, physical inspections to virtual inspections, be a little bit more lenient with some of those requirements, work with, all the parties that are involved so that we don't have continual hiccups in terms of moving construction jobs forward, causing additional headaches more than the properties, the property management folks that are working on in-place rehabilitations, relocations, the developers that are coordinating with the contractors, trying to maintain all the safety protocols throughout the property during this time. So, it's been very important that, we, get ahead and create those plans and processes, and adapt to what we're hearing from, the development team, the developers, and, people on the ground. So in terms of ad hoc, it's been a lot of what was, mentioned during the previous panel in terms of rental collections, maintaining those relationships. I think Brent had mentioned a lot of good things about, how this has strengthened, a lot of people that are working together and sharing information across the board. I think that's a lot of good that's, come out of this. People are not hiding information, not hiding best practices. We're all trying to figure out, how do we do our job better? How do we help the people that are at the sites do their job better? How do we create more flexibility? And so I think a lot of that, you're explaining to investors and saying, we're in constant communication with these ever, way more now than we, even were before. And you're trying to balance that with developers and property managers as best you can, because you don't want to overwhelm them. You don't want to impact them in any sort of negative way.
So continuing on, Dina, as Greg has talked a little bit about COVID, what additional issues have you seen during the development stage, conversion stage, with your general partners because of COVID?
Sure. So I think one of the challenges that everyone's facing, is acquisition rehab and how to do in-unit renovations. And so obviously there's a lot of protocols that are coming out about how to do it. It's, very state and jurisdictional specific. We've seen the gamut. We're in 12 states. we've seen the gamut from having to barricade off units and have corridors through units to get to spaces for contractors. We've had to handle relocation and vacancies differently. Our newest plan for some rehabs that are closing in September involves cleaning protocols before, cleaning protocols after, and additional expenses for those. And so those there's sort of the whole construction and how you administer your construction side of things that we're seeing. Definitely some policy changes. And then I also think working with agencies, those have cost repercussions, and that coupled with, at least in the case of 4% deals, the rate being low, is seeing some deals, if the 4% rate is at 309, it should go up and it will go up, but those kind of tensions moving together, we've seen some creative responses from agencies dealing with that and with investors in order to work around there. We've also seen in select states, folks coming out and allowing a longer period of time for placed in service and credits of a certain year. And so all of these things are helping, but I think it gets at the point that Denise was making around flexibility and your partners and people in this together. And so, I have never been prouder to work in the affordable housing industry, and more particularly used to be in a development role, in an asset management role, and see this collaboration. So I think there's lots of solutions to bear, but I do think it requires flexibility and an openness and like a disposition towards yes, rather than no, or that's too hard, like sort of finding a way to say, okay, let's roll up our sleeves and let's think creatively. And let's, we had an issue on a phase one where someone couldn't get back to do the phase one, and what can we do and how can we close? Because we have a phase one that's now 12 months old because COVID delayed our closing. And, how does that work? And so I just think flexibility is key. And then state agencies' involvement in rules and deadlines and people coming together to solve things. Because what I don't want to see happen is that we find ourselves in 6 months, 12 months, 18 months, that this impacts the pipeline in such a way that we're not producing housing. And so I think that's the risk. And hopefully we will avoid that by this collaboration.
And do you feel like you're getting it?
I have been. I do feel like we're getting it. I think Greg made a great point about, because investors and lenders are going to have to review special things. So you're going to have to review, the COVID cleaning protocols and make sure that you're comfortable with that and that we're going to approach this. I think where there's anywhere to give on, like, we actually don't need this, or we're going to forego this on this transaction because we're doing this other thing, would be a great help, I would say. And I've seen some organizations do that, all things in balance, like, what raises to the top and what could we let go of, or with this different level of scrutiny or different level of involvement, so that we can really double down on delivering well amidst COVID. And so I think it's a balance.
And Kristen, I'd like to circle back to you and ask you how COVID has changed the way you look at things during this construction period, the development period.
Sure. So COVID has most certainly driven our focus more intensely to deals in this phase. I will reiterate what Dina said, that the collaboration, the communication with our partners has certainly amped up, and we're seeing things brought to us that are challenges that we all just have to adjust to. I mean, this is our reality right now. We are all in this together. We all want the same end. And I think that openness to really look at what the situation is, find out what the most important parts are, and then figure out how to get to a yes, how to move a project forward, is really what we're focused on right now. And it's a challenging time. It really is. And these are complicated deals on a good day. Now throw in a pandemic, everyone has to be at their best, and everyone has to be able to roll up their sleeves and dig in and find a way forward. And I've been impressed with our partners. I've been impressed with our team on how willing everyone is to come together, to communicate, and to find a way forward.
And one more question. And what do you find in general it is doing to the time needed to close the pandemic? How is that affecting time needed to close?
Yeah, there's certainly a lot more eyes on deals, a lot more potential pitfalls to work out. So everyone is fully committed to moving towards a close. It's taking a little bit more time, and by a little bit more time, it's manageable. Certainly manageable, because I think everyone is so committed to making certain that we're moving forward, that we are providing affordable housing because it is so needed. So I think that, yes, there is certainly a longer time frame, but certainly a manageable time frame. And I think it is a direct result of how much commitment there is from all parties.
And Denise and or Dina, do you feel that the delays are manageable from the developer perspective?
I think so. We haven't, we anticipated there would be some delays, and, it all goes back to, obviously, as Dina and Kristen reiterated, it's like to the, cooperation by everybody to understand that everything, construction, conversion, lease up, it's all going to be delayed somewhat based on where we're at. And it's that relationship that you have with them that's going to dictate how, and how we move with these different syndicators in the future, how they're responding to us when we have a concern or we have a breakdown in regards to it. And, is this somebody that we want to transact with in the future?
Dina, anything to add?
Just on timing, I think that I agree that delays are manageable. I think where with some organizations and agencies, it's been harder that haven't had the remote capabilities. I mean, everyone on this call, and I think on the prior panel, was talking about how everyone's thriving remotely. I mean, I have great productivity from everybody that I work with at POA, but with some partners who haven't had the technological ability to work from home, there have been delays. I mean, we're doing sort of remote TEFRA hearings, the remote board meetings, and those took a little while to get going. And so I think between that and the extra protocols, it's putting 30 or 45 or 60 extra days on transactions is what we're seeing at our shop. And hopefully those new protocols will just kind of fold in. And so we'll see some of that erode once they're developed. But because we're starting from scratch, we're handcuffed by the technology a little bit in some cases, not us as much as some partners, whether it's smaller housing authorities or certain state agencies. But many have been also super productive and super able to work remotely. So it's kind of a mixed bag.
So I had to laugh when you're talking about the technological capabilities of some of the people you're working with, as I watch Caitlin having to mute me every time I stop speaking. So my technological capabilities are probably not that great either. So I apologize. Okay, so from what I'm hearing, that COVID, at least in this phase of a partnership life cycle and a project life cycle, COVID has provided obstacles, but it seems like the communication and the understanding of the needs of either side is going along pretty well. So that's a great thing. Okay, I am going to move us along. If no one else has anything to say on the on the development conversion segment, and we'll move along to the stabilize segment. And I'm going to start with you, Brian. I guess the first thing, in general, forgetting about COVID for a minute, but how do you think ad hoc asks are handled during this period?
Sure. I think ad hoc requests are interesting, because what we should have by the time we get to exit or close to exit, we should have 15-year track record of dealing with our asset management team on any particular property. So I'm hoping that by the time we are making any requests, that by that time we have a long track record, we have a good relationship with the asset management team. And really, the way we try to handle our properties is we try to get out in front of any issues. So by the time we're asking for anything, it shouldn't be a surprise for anyone, because we should have already been doing some preemptive reporting and and making sure that the asset management team is aware of any situations that might be developing or any milestones that are coming up. I know one of the things that we tried to institute here, was we took a look at AHIC's watch list criteria. And so we took that criteria and we graded all of our properties according to AHIC's criteria, and then we look at them kind of monthly or bi-monthly basis to see if the grades are changing at all. And then we know if they are, then we reach out to the asset management team on the property to let them know, what we're seeing and how, and more importantly, how we're going to fix it. So I think by the time we get to an ad hoc request, hopefully there's no surprises and we've done our job, and that helps kind of smooth any sort of decision making on those.
Is there one ad hoc request that seems to cause more angst from the limited partner than others? What seems to be, is it refinancings? Is it pulling money out of reserves? Transfer of ownership? Is there anything that stands out as being somewhat, from your perspective, problematic for the limited partner?
Well, I think I work on, the most problematic thing I work on is investor exits, right? Because there's sort of there's a different continuum of, I don't say understanding, but of how different investors approach it. And so that's always been, our most difficult request is how to get the investor out. And, I think part of that too is, we don't have as an industry, we don't have a huge long track record of year 15 activity. We're just starting to kind of ramp that up and more and more and more. And you can kind of see like the evolution of, if you go look back at old deals, you can kind of see the evolution of, the options and the forced sales and the whatnot. And, those changed a lot in the early days to the point where it seems like no exit right now is quite the same. But I'm hoping in about, 5-10 years, it would become a little more standardized. So.
Dina, what do you find is the ad hoc asks in the stabilized period that causes the most angst?
Well, it's hard not to think of like specific examples and like put too much weight and stock into them. So an anecdote, but is one thing that sometimes I'll struggle with is if we've made an ad hoc request, whether, I don't know, let's say it's an early exit or use of a reserve or consent for something. And the response that, whether me or someone on my team has gotten didn't come from a spirit of collaboration. And it's fine if someone doesn't want to do something, but it seems in some cases I have found that it's an answer. And I find myself wondering if anyone else at the organization knew the question, would the answer be the same? And I don't say that, I don't mean to sound disrespectful in any way. Same thing can happen to me. Someone might ask someone that works for me a question, and I might not always agree with their judgment call. And so like this tension or this awkwardness of when you might raise it or not, and I don't want to step over anybody's head or, I like to have a nice relationship and a good rapport with everyone, and that never feels good. I mean, let's all be human. So I would say that sometimes that comes up, and I still don't, 15 years into this, gig, I still don't know always what to do in those circumstances, because I don't love to jump over someone's head. So that's one thing that comes to mind on ad hoc requests. That's not a majority of cases. That's a minority, less than 10% of the time. Most of the times you can have a reasonable dialogue. You can understand both sides. You can try and find, Pareto optimality, a win-win, increase the pie. Like what are your needs? What are the needs of the investor you're working with? What are the hurdles? Is it attention? Is it financial? Is it, what are the barriers? And we can break it down. I really enjoy when you can have a candid conversation and you have, that good of a rapport with a partner where you can you can just both lay your cards on the ground and you can figure something out. I mean, I have found that to work best. That isn't everyone's style or authorization or authority. But we have come up with some creative solutions to situations when people are willing to engage in that conversation or raise it above them, and say, let me put someone else in.
Do you ask why? And do you get an answer for why? Or do you find that your partners explain to you why they need what they need?
Not always. I would say like 80% of the time, yes, but 10 to 20% of the time, no. And then you're in that awkward spot that I was describing as the minority of sort of not responding or haven't given an answer that has any logic to it. And now what do I do?
So, Caitlin, Kristen, what's your rebuttal to that? Do you find that, do you believe that your general partners understand why you have to give the answers that you do? Or is that an area where we need more communication?
So I think it's definitely an area that could benefit from more communication. I don't know that it's always completely understood, and that goes both ways, because communication is a two-way street. I think one of the most challenging parts from an investor perspective is we're constantly trying to balance being a good partner and doing what's best and providing timely responses with receiving the information we need and operating in the organization that we're in, because we are still one very small part of a much larger organization. We are still tied to certain guidelines, certain parameters that we have to operate in. But I think Dina makes a really good point that having that conversation, getting the partners to the table to discuss it, frequently leads to positive outcomes, because you can then discuss where each person's coming from, what we're trying to get accomplished, and what the options are. And yeah, perhaps there is a creative way to get there, and it's much easier to come to that if you're communicating and if you have that relationship to work off of.
I've always found that the understanding the why is so helpful, just to
absolutely.
get through issues and to really strengthen relationships. I understand that we have some questions from the audience, from other attendees. And so I'm going to move off of my own questions for a couple of minutes here and put some of these questions out there, if that's okay with the powers that be here. Okay, so this first one, oh, wait a minute. So somebody, all right, so let's see, open. What is the key asset portfolio relationship on key issues or challenges? Isn't there a broader management of LPGP that needs to be explored first before deal deep dive? How are they managing in a crisis and being upfront? Are relationship plans on equity, debt, construction, lease-up guarantees, place in service being done by all parties? Okay, so relationship plans by all parties. I'm gonna send this over, maybe just, I don't know. Caitlin, do you wanna try a stab, and then we'll send it over to the development side to see what they have to say?
I think you might have meant Kristen.
I did mean Kristen, I'm sorry. What is the key asset portfolio relationship on key issues or challenges?
So right now we're looking at how our partners are communicating, how they're looking at the portfolio to make certain that they have a good understanding of what the risks actually are. Specifically right now with COVID-19, there are a lot of discussions about what the bigger picture is, what the bigger plans are portfolio-wide. So I'd say that's where we're focused.
Thank you. And Denise, how about from the developer perspective or the general partner perspective?
I agree with Kristen, and especially the last 3 months have really shown we understand that there are many upper tier investors who are watching what happens here, and so we are mindful of that, but at the same time we're also responsible to our partners, to our management companies, to make sure that we're not putting an undue amount of stress on them in them trying to do their job. We had some in the first month or so of this. We had some real challenges with investors, and I think that once we all could discuss it, we came to a mutually beneficial way of moving about for the next few months. But we also ran into some problems with some that took some time to overcome, and You know, we work with 16 different syndicators, investors, and so it is challenging by the sheer number of them. But we just found if we reported, we gave them the information they needed, that we were getting far fewer requests. And you know, but it all goes back to the relationship. I mean, I think we've all said that. It just goes back to the relationship that you have, and you know, it dictates how things are going to go. And I think we brought, not only from an asset management standpoint, we've brought in the originator into conversations, because we're finding as we're closing deals, they need to be made aware of what exactly is going on with the portfolio too. And so just being transparent with them and coming to an agreement, but also to your point, it's, you know, we understand they have requirements and they have people that they're reporting to, and getting people comfortable with where we are is important.
I'll just add real quick. So sort of sitting here and thinking about relationships and syndicators and GPs, LPs, we have 28, so I feel your pain, Denise. We have 28 different syndicators that we partner with or have partnered with. And at lots of them, you know, Patty Kulik, who works as one of our senior portfolio asset managers, has a good relationship with folks, or I have a relationship with folks, but at some we do not. And so my one takeaway I'm taking away from this conversation, it's not that we don't have a good relationship, it's that we only have one relationship, not multidimensional. And so if that person leaves, then sort of institutionally, you need to have more connections. And so one takeaway I'm taking from this conversation and some of the questions is just where we don't have that depth of relationship, working to form it and making it a priority at all levels. And so that you have kind of the ability to have these conversations and get things solved.
And I understand that Tom would like to weigh in on this question too. So Tom, you there? No.
Oh, I didn't have something to add in there. I was going to share, I closed it out, so I might as well say this now. There were some questions earlier about the Affordable Housing Investors Council and the underwriting criteria, watch list criteria. So I did post a link to those resources both in the Q&A, and I'm about to put it out in the chat for everybody as well. And I know Marion, you were involved in a number of those initiatives during working with AHIC. So.
Thank you. That's very helpful. Okay, I'll give another question here. To the investors, have you been asked, so Caitlin, Kristen, if you wouldn't mind answering this. To the investors, have you been asked to forego distributions so that the money stays with the property? And if so, have you agreed?
Yeah, so right now, it's new uncharted territory, and there are a lot of asks that are coming in, and we're looking at all of them, and we want what's in the best interest of the partnership. And I know that may sound odd as the limited partner, but we do want the health and stability of those properties. So if that's an ask that you're considering, make the ask, because investors do want to do what's best for the property, and it will certainly be considered.
And I guess this one probably should have come before the last question, but Greg.
Can I jump in, actually? Can I just jump in real quick on the last one?
Okay.
So at POA, we made that request only in one instance because most of our distributions had already gone out the door in March, April, and so it was what it was. And the response we got from the syndicator from the upper tier relayed was that that's something they'd consider next year, and they had already counted on that in their budget. And so that was a little disappointing. I can't be authentic without sharing that.
Thank you for sharing.
Distribution,
Thank you for sharing. I can represent one investor specifically. And I certainly hope you're hearing something different from others.
Go ahead, Greg.
I mean, there's certain things that are cash flow oriented and can, do come before distribution too. So I think in most cases, and I haven't denied any, deferment or suspension of, incentive management fees or fees that are subject to cash flow, to paying deferred developer fee, any of those items. I mean, I think that just makes sense. And I think, most people are doing that type of stuff there. It goes back to, they're trying to set up the partnership to weather, uncharted territories and make sure that the cash balances are as high as possible, that, if rent collections do dive, if there's, additional expenses or, anything that's just unforeseen, that they're ready to handle that and weather that from a partnership standpoint, as opposed to needing to have a even, bigger conversation about we need more money somehow. I mean, no, people rather handle the situation, with cash on hand than, having to go to their lender, having to go to their owners and say, guys, we ran out of cash because, for, one reason, or because we made a distribution and that money's gone. So I think there's definitely, a lot of evaluation of that, even more evaluation of what reserves people have on hand, when equity's coming in, during the development period, when, certain reserves are being paid from an equity installment perspective, if it's after stabilization or rental achievement, there's much more people in tune with, I think, this now more than ever is what I'm seeing.
I'm hoping it was an anomaly, but it was an elevator, so it was pretty disappointing,
Yes.
But anyhow, keep going, Marianne, sorry.
No, I was just going to say there was another question that I think Greg has probably answered, but if anybody else wants to jump in here, it says, what COVID deliverables are investors requesting? And what are GPs experiencing in COVID-related requests? So I guess that's the same thing. So Denise or Dina, do you want to handle that?
We initially we received a lot of requests, 2 to 3 page, full of questions about each project, and we just simply declared early on we weren't going to complete those. It was, we have 170 properties, lenders were investors, and we just said, we just don't have the capacity, nor do we want the management companies stopping what they're doing to fill out all of your forms. We had discussions with many of our syndicators early on to say, this just isn't reasonable. And, we want our management companies to spend their time focused on rent collections. And so we then came to, we developed a form that we now send to them 3 times a month to let them know updates on rent collections and, anything that's impactful to the project related to COVID and deaths or, manager or whatever. And so we found that having those conversations early on and kind of, understanding that that questions would come up throughout, we were fine with, but we've, we also haven't done distributions either. But Dina, we also ran into one syndicator who early on declared that they wanted their asset management fees. And, but, it's just, it came down to having those conversations early on saying, we just can't do this, but let's find a reasonable way that we can get you the information that you need in a way that's doesn't impact us or the management companies in a significant way.
Brian, has your experience been any different?
It's almost been exactly the same. I think when it first hit, we got inundated with requests for all sorts of information, and we had to sit down and look at it and see what everyone was requesting, and then we decided we'd come up with sort of one standard report that we could use for all of our investors and lenders. And we went out and we talked to them, said, look, we can't do 200 unique reports, but we can offer you, this report, and here's what it has in it, and we can do that twice a month for you. And, frankly, it's good information for us too. So, it's beneficial for everyone, and it was a good opportunity to work together. But I have to say that, for the vast majority of our, asset management relationships, they were they were perfectly fine with that, and it worked out well. We had one investor push back a little bit, but I think we got through that. And but yeah, our experience was very similar to what Denise just described.
It seems like you had a very reasonable response or solution.
I hope so.
Yeah, it seems that way. I hope it was acceptable. Okay, so have investors been approached to waive downward adjusters given construction and lease-up delays? Or is this dependent upon the relationship?
So I'd say everything is dependent upon the relationship, and relationships are, as we're seeing, the most important part. I anticipate that that will be a question that comes up. As of right now, we haven't encountered it yet, but it's certainly something that we're looking across our portfolio that's under construction and in lease up, and keeping an eye on that. We certainly anticipate those questions will be asked, and we will absolutely entertain them. It's a new situation for everyone, and everyone is just trying to get through it the best that they can and make certain that at the end there's a property that is stable and able to support itself. So yeah, I would definitely recommend having those conversations.
And someone also wrote, are you allowing properties to access operating deficit reserves?
So we're always looking at reserves, and we're always looking at requests that come in to use those funds. And certainly the reserves are there for a reason. And that's absolutely a discussion that we're having with our partners to see if that is the best use of those funds. The reason reserves are set up is to help property stabilize in uncertain situations. And this is most definitely an uncertain situation.
And Greg, would you agree with that from what you're seeing?
We've had a few reserve requests. I think it's, dependent on the situation. Certain deals were structured where reserve wasn't funded. Certain developers have asked just to get ahead of the game, just to start the conversation. We've had, I think one deal where we've approved recently in terms of an operating reserve release, that was minimal. They were having issues with rent collections. It made perfect sense. Where, like Kristen, evaluating on basically a deal by deal basis, trying to make the most sense and make the best decision, not only for our investors but also as a partnership and investment. I think it kind of also to sort of address the adjuster conversation. I think it comes back to a lot of what maybe Dina and Kristen were talking about earlier about, sort of just communicating together. What is it that, the limited partner wants, or what are their needs, how to figure that out. And I think more than ever, people are figuring out, what's important to them, how to, over time develop, that, relationship and develop that understanding of what, drives the investor, what makes them happy, in order for you to go, maybe you had an adverse situation and 6 months later you say, well, wait a sec, 6 months ago I was working hard to delay your equity. I went out and got a cost segregation study to, to improve your losses. I also, maximize your credits, in this way, one way or the other, made sure that we delivered the utmost amount of credits this year, delivered all your reports on time. Make that case, know what you've done for your partners, and so that you can have that conversation and try and find, what works for you and what works for them. Because I think these conversations, they're happening in real time. And I see a lot of it happening between construction, nearing construction completion and through rental achievement stabilization. How do I access my equity? How do I reduce my interest, burden? Can we split up this installment to maybe benefit the investor as well as, reduce the interest burden to us to benefit the property? And a lot of it comes down to, right now, it's a very changing environment. there's like so much legislation that's coming out. People are dealing with the PPP loans. There's, the 4%, rate that, is really depressed. There's, the conversation of that continues to go on. And, this stuff will play itself out over time, but I think, it comes back to the communication and making sure you're doing what you can for your partners to have that conversation and make sure that you're standing by what you agreed to do, and your investor limited partner is doing the same thing.
Thank you. And I think we're out of time here, but I do want to just to wrap it up, just say that it seems to me from the conversation that we've had that the state of communications between general partners and limited partners is pretty good. I'm sure, like any relationships, it can stand to get better. But, I think we need to keep on doing what we're doing, that over the next few months, we're probably going to see, there's a lot of uncertainty given the pandemic that we're in. But it seems from both sides that both partners are anxious to get to the goal of getting the property built and make sure that we're providing safe, affordable housing. And to that end, it seems that communication, keep talking, and we'll get there. So I think things look pretty good. There are a few more questions, but Tom, I think we're out of time.
Yeah, I wish we had a little more time, but I do want to thank our panelists again, Kristen, Brian, Marianne, Dina, Denise, and Greg. I thought that was a great session. We'll try to get to the remaining questions, by email or in sort of the after discussion in the app. But thank you all. And I'm going to now, again, thank our panel and remind everybody that hasn't done so already, fill out that survey in the chat about the breakout room so you can RSVP for the topic that's of greatest interest to you personally. We'll be starting that in about half an hour, and we'll be uploading the room participants shortly.
But wait till you hear mine before you do so.
But yes, and to that end also, we are really grateful to have David Smith joining us now for our keynote address. David's probably somebody that doesn't need an introduction for this audience, but I'm going to give one anyway. David, to me, is really one of the true unique voices in affordable housing. He's a visionary, and literally NH&RA presented him with our Affordable Housing Vision Award in 2009. And we were so moved by his remarks that he made at that session that we then recruited him to serve as our resident or non-resident guru, where he writes a monthly column for our magazine, The Tax Credit Advisor. The last print copy that I have since going into quarantine in my hand here on Ozones, but he's written several more since. It's a place that really is focused on provoking new ways of thinking and discussion in the affordable housing space, and it's always the first thing that I read in the issue. He's an innovator and an entrepreneur who's made a business of helping affordable housing owners and investors transform their portfolios. He's a trend spotter and creates transactional models that add value and improve affordable housing. He's founded Recap Real Estate Advisors, which is one of the nation's leading RAD advisory firms. He's a pro bono policy advisor, a prolific author, not just in TCA, but beyond, and somehow has managed to also find time to create the Affordable Housing Institute, which is an international nonprofit that works to deliver improved housing production and housing finance ecosystems in over 50 countries around the world. Wow. Anyway, when David speaks, I always pull out my notebook and listen, and I think everyone here today is going to really enjoy his presentation. So without further ado, please welcome David Smith, the guru.
And I'm using Caitlin's screen, but I could use my screen instead. Caitlin, if you could drop yours off and let me drive it, that way I can click through the slides for the fancy animation. Thank you, Caitlin. I wish I could see everybody, because part of the fun of doing something like this is to be able to see everybody. Never mind that. Of course, part of the fun for you is you get to see me misclick the buttons. what I want to describe here is what I believe is the next big thing. And after we get through what you all have been going through, I think we're going to look back on this period of time as the time in which the next big transaction business and upgrade in the physical quality and the operational quality of what we do will be seen to have occurred. I'm going to go through this relatively quickly, introduce a little bit of new jargon, but then in the original polling, there was a breakout session for something called Health Secure Housing, and I am informed by the elves that no one signed up for it. Now, aside from spectacularly hurting my feelings, I figure the reason is probably because you had no idea what it was. So I invite you, in the tradition of absentee ballots everywhere, to reconsider your vote on polling day and potentially to consider going to this breakout room so I'm not there by myself. I put on the basic slide here an image that I pulled from University of Vermont Health Organization about staying home, being safe at home. And even though this is designed for a single family home, I thought it captured several of the important truisms that the last 2.5 hours have made manifest. Namely, that inside the home is the most important health environment for any person or any family. And secondly, how people interact inside the home will affect how healthy they are. And third, certain kinds of technology and systems need to be present in the home. And ever since this happened, ever since I was forced out of working from my office and into working at home, 3 days into this, I came up with this phrase, and I'm convinced, as I said, it's the next big thing. So in this highly organized fashion, I'm going to spend a little time talking about what healthy living after reopening is going to mean, try to give you the concept of health secure housing, suggest elements that represent a scorecard by which all high-density multi-person dwellings should be evaluated, talk about a bunch of paradigm shifts, and talk about, I believe, how this will become the norm. I should mention also, Tom alluded to it, but in deference did not emphasize it. I have been doing this business for 45 years. And having been that, I've been through 4 recessions, 6 technological disruptions, innumerable presidents, and more permanent laws repealed than I can remember. And after that, there'll be questions and answers for those of you who want to pursue it. And if you miss that opportunity, we'll be doing a town hall on June 25th at 3 p.m., which will turn rapidly into an Ask Me Anything or food fight. So in that, I put up in the upper right-hand corner 2 schematic images, which were intended to depict wet and dry. And I'm going to suggest to you that a lot of encounters in the property management and asset management and rental business are wet encounters where droplets or aerosol particles can go back and forth between people. And we have to turn them into dry encounters because right now, everybody in America is concerned about wet encounters. Social distancing is all about minimizing wet encounters. And how did we do that? The first thing we did is that workforce housing now means work from home, which it didn't mean 3 months ago. Indeed, all of our panelists presented from home. All of our moderators presented from home. Most of the organizations, anyone who can, works from home. I'll come back to some interesting issues of exclusion that result from that. But that's a shift, a dramatic shift, and one that came up in the first panel. We will never go back to the office environment exactly the way it was 3 and some change months ago. Additionally, why can't I click? There we go. Additionally, the first thing that people have ended up having to do is to establish that they live in a health secure environment. The whole first panel focused on how do we make sure that the place our residents are living is healthy and secure. Because after all, aside from the fact that once you call something health secure, who wants to live in health insecure housing? The second part is that various laws enacted after World War II to get rid of flop houses have imposed on landlords the implied warrant of habitability. meaning that when you offer housing for rent, you are warranting that it is habitable. And that was a warrant you could make as a landlord or an owner or an asset manager or property manager 3 months ago without thinking twice. It was absolutely habitable. The tort lawyers have not yet come, but the cases will come in which the warrant of habitability will be used to challenge whether owners and landlords and property managers have taken steps to make their housing safe and habitable. That is going to come, and you're going to have defense for that. I also invented something else just to give you a context of it, because I think this is also important. We're all familiar with 6 degrees of Kevin Bacon. So because I think in very odd ways, I started saying, well, let's define everybody's Kevin Bacon coefficient as the number of people you get within 6 feet of during a day. And I'd like you all to think about 4 months ago in your workday, how many strangers did you get within 6 feet of in your workday? When I estimated it for myself, it was 200. Because I would walk to the subway, I would stand on the subway platform, I would take the subway downtown, I would go from the subway to my office, I would go to the lunch place, easily 200. What do we know about social distancing? You try to reduce your Kevin Bacon coefficient. Part of how you reduce your Kevin Bacon coefficient is commutes shorten in distance and they shorten in volume. And both of those things contribute to making housing more important. Again, I want to emphasize, I'm thinking of the world in 3 kinds of interpersonal accounts. By the way, all of you who are in property management, all of you who are in development, think about whether an interaction that is occurring at any site you operate is a wet encounter, where people come together and can exchange aerosol particles or bodily fluids, a dry encounter where they come together and know that that will not happen, that not only it will not happen, they know it will not happen, or a scrub encounter. Many of you have put in place new protocols to make sure surfaces are clean, apartments are clean. Property management people wear gloves and masks. Property management people have hand sanitizers. All of these kinds of things. Every single encounter that people that you employ, people that you house, people who visit the people who house, vendors who come on the site, every single encounter has to be rethought as to whether it is a wet encounter, a dry encounter, or an opportunity to create a scrub. That turns out to be an organizing lens by which you can start to understand how the environment in which your residents live and in which your investors have invested and your lenders have lent has to be changed so that people are safe. Because once you're inside the front door, people want to be safe and know they are safe. I was struck also in the first panel by the discussions that all of the asset managers there held in the COVID response about how they were checking in with their residents, extending their employees were checking in with residents, extending interpersonal and social communication way beyond what's allowed in the lease, and in the course of those conversations, the kind of information that HIPAA does not allow to be exchanged was exchanged, and it was exchanged for a very practical reason. Reason was people were worried and other people cared. What was the message? I want to check in. And so we have gotten to a curious place, I respectfully suggest, where everyone you live with, it's healthy to think of them as part of your health family. When we are inside a dwelling together, when we're inside an office together, we all have a stake in each other's health. And the way we find out about each other's health and wellness is through observation and through conversation and through trust. I'm going to use my hands this way a lot because trust is an interpersonal relationship, and things like handshakes are symbols of trust. They're now, of course, symbols of something else, but so be it. We build trust only over time. You can't be well unless you trust the people you're living with. You can't trust the people you're living with unless you build the trust. Now, some of that, I want to mention, can be built technologically. Tom was kind enough to mention that I work globally, and that's true. My nonprofit got some money from the Gates Foundation. We invested in a housing microfinance company in India that makes loans to informally employed poor Indian women, right? India went on lockdown. Well, guess what? The more informal you are and the poorer you are, the more wet encounters you have during your day. And when that happened, India went into lockdown, and the government of India recently launched that app that I've shown there as they come out of lockdown. That is the world's fastest adopted app. In 13 days, India signed up 50 million Indians to Arogya Setu, which is an app that uses GPS to alert you if you came within 2 meters of a COVID positive person. It's privacy first by design, it's scalable architecture, and it's available in 11 languages. It's an example of how trust and security get connected to technology. Now, Americans, you guys looking at this go, my God, HIPAA, my God, lease restrictions. How can I get this? My God, privacy restrictions, face recognition software. Americans don't think quite the same way that people elsewhere in the world did. But imagine if you had one of these just for your employees. Imagine if the residents of your property had that just for each other, so that it was a private network, not a public network. We can start to see how technology can be used to make the home safe and make the people in the home think they are safe. And people will only download that app or give you the information when you call, when you trust them. There was a comment about, I don't want to receive emails, I want to talk to people on the phone. Why did people want to talk on the phone? Because that's a trust and a personal relationship. All the emphasis on personal relationships in both panels we heard today is all about trust is built person to person. Over and over again in the last 2 hours I heard that. And so there are going to be 5 dimensions by which we create health secure housing. Medical, physical, operational, informational, and economic/financial. And we're going to do this in part because living well, whoops, let me go back. Can I go back? I can't go back, never mind. Living well will extend your health span and save everybody money. So for the last 3 months, living in the future, we've been trying to build this thing, and we've made an enormous amount of progress. This is very schematic and conceptual, but you'll get the idea. Think green CNA. Think energy conservation. There are 5 dimensions. Inside residential property, there needs to be some amount of medical testing, some amount of wellness tests. Maybe when you walk through the front door, you get your temperature taken remotely. Maybe when you go to when you go to a social environment, you have an opportunity to get a check-in. Maybe there's automatically a place where you can get scrubbed going in and going out. You have on-call, on-premises testing. You have a wellness program. Maybe as you think about it, shifting from medical into physical, you set aside within your property 2, 3, 4 apartments for recovery apartments. Somebody tests positive, you move out of the social environment into that for a short period of time. That might cost you 2 points on vacancy, but think what it does for everybody else. I understand we've got tax credit rules. I understand we got complicating things. I'm treating this that within the CARES Act or CARES 2 or CARES 3 or HEROES, there is going to be pilot opportunity. There's going to be waivers and pilot opportunity to pursue this kind of stuff. Whoops. Oh dear. Now I must actually go back because I completely screwed the pooch. So we'll go there. Beyond that, we have to curate ingress, egress, social areas, and activities. At some point, you're going to start dividing your, I see a question popping up. The question's a good one. I'm not going to answer it right now. Save them for the end, because otherwise I'll never get through this and we'll never get done by 3 o'clock and you won't be able to escape me and go to those other breakout sessions. We're going to have curated ingress and egress. We're going to have some means of screening, and I suspect you will classify spaces within your property as private, low social, high social, with different protocols. Maybe you paint the floors different. Maybe you have different colors on the walls, but means of indicating how you're moving. I do think that you're going to spend a lot of time in property and management, asset management, reconfiguring staff and resident interactions. For example, when it comes time to rent an apartment or do an inspection, instead of doing a walk around with a resident, maybe you give the resident a tablet and an electronic key to the apartment, and the resident carries the tablet either before him or her or facing him or her. So you talk to the applicant or the resident as he or she walks in his or her or their own time through the property and identify stuff. You can do that. You could do this with in-apartment inspections. You could do all kinds of things that way by bringing digital technology and portable digital technology into the resident encounter. Similarly, I believe we will see tacit and then explicit understandings as to what personal health data residents are comfortable sharing and to whom and what it is used for. Now, this is not adequately protected or authorized under current law, but sign up for Amazon, sign up for an Apple phone, and guess what? Apple and the NSA already know it. So people are prepared to give up a certain amount of their personal privacy if it gives them more security, better service, and it's given up to people they trust. And then lastly, we're going to have to fund the cost of the retrofit. We're going to have to fund the cost of the increased operations. And I'll give you 5 or 6 of them. Strategically assess the income and expenses of your property for the following 5 things. 1, stabilized vacancy. 2, concessions/collections, because it is going to make sense in many cases to reduce your rent or otherwise grant some kind of concession rather than pursue an eviction for all sorts of reasons that have been talked about in both panels. 3, turnover. On turnover, you are likely to spend more money renting, leasing, prepping, and otherwise than you would have done before. 4, hazard insurance, property insurance. Get set for whenever your insurance policies expire. We've been through this. When your insurance policies expire, you will have a big jump in your premium, a bigger jump in your deductible, and you'll be lucky to get it. Okay? And then 5, financing. If your housing is not health secure and you're not already trying to close something you're trying to close, you're going to have a challenge eventually getting to Fannie, Freddie, or FHA. And so that leads us, click, that leads us to these ideas. The one I want to call attention to is intra-property cultural networks. We all know that affordable housing communities, we call them communities for a reason. The people who live inside them form their own groups. And the less they see contact with managers and owners and outsiders, the more the group is insular. And there have already been, as you know, tragic stories of people dying in public housing because the staff couldn't get into the public housing to check on them, and the social distancing that was enforced in public housing had the effect of preventing people from checking in on one another. I strongly encourage all of you to start to see to identify the intra-property networks of people in your properties now, and encourage the residents to strengthen those networks because they become a smart system. They become part of the health and wellness operations of your property. 2 other things. Next guru column, preview of coming attractions. Every time there's a catastrophe, it reveals weakness in infrastructure. And we have 2 forms of infrastructure that are now part of public health infrastructure. The first one, broadband, free to the user, in the home, is now part of health infrastructure. Greg Doble knows, because once upon a time I sat on R4's investment committee, that 10 years ago I was saying I want free broadband inside every elderly apartment complex because it's a wellness element, it's a resident connectedness element. Today we know that if you don't have free broadband inside the property, inside the dwelling, it's harder to work, it's harder for the kids to get educated, it's harder for entertainment to come in, which means people get angry with one another and stressed out and depressed. It has now become a health utility. The second, and I put up this chart up here. That's our broadband map, but I respectfully suggest that that broadband map is wrong. because it suggests that there's plenty of broadband in the big cities. And I think, because this is county level, I think if you zoomed in, you would find data deserts, broadband dead spots, and you would find them in public housing and older assisted housing, and perhaps even some of the housing that you folks own and manage and asset manage. And it's in those, and those data deserts, those broadband deserts, not only undermine social connectedness, they undermine economics, education, everything else. And as we're talking about things in the context of equity and exclusion, if you're cut off from the broadband, you are excluded in ways that are structural, not necessarily racist, structural, but nonetheless debilitating and self-reinforcing unless we do something. Same argument on mobile banking. We are doing a lot of work for the residents of an 1,100 unit public housing project that is going to, public housing residents, that is going to go through a massive demolition rebuild, comprehensive demolition rebuild. I have learned firsthand in the last 3 years how much of their interactions are cash dependent, person-to-person dependent, not on the internet, not on broadband, not banked. And again, absence of free mobile banking, electronic banking for residents inside these properties is now a public health issue. If we are going to reverse economic exclusion, social exclusion, racial exclusion, inequity, whatever you want to call it, we have to tackle infrastructure exclusion, which means we have to tackle infrastructure gaps, which means installation subsidy is needed. And so how do we get there? I put up that because it turns out there is something called the U.S. Public Health Service, and it was created in 1798. Because it turns out every government everywhere eventually responds to certain kinds of health catastrophes by saying, hold on a second, public health is in everyone's interest. So step one, regularization occurs in 6 stages. And I can say this because I have been through in my glorious career: lead-based paint, asbestos, underground sprinklers, underground storage tanks, sprinklers in high-rises, radon, mold. Every single time, first step, oh my God, we have a problem. You have to independently inspect and report. Someone, not you, has to come in and say, here's where you are, here's what your standard is. You have to remediate urgent hazards. A lot of you have done that already. That's what you've been doing as you've re-engineered processes, and that's fantastic. I want to echo what I think it was Dina Shifara said. This is a great time to be in affordable housing because what we do is now understood by almost everybody to be fundamental to people's lives. So we've remediated urgent hazards, and you've done a fantastic job of that. We have to encapsulate and isolate the lingering but controllable hazards. The next time money changes hands, we better retrofit. Somebody's going to have to certify that we retrofit according to some sort of new health security standard. I put up green certification. Green certification didn't come out of nowhere. It came because people wanted to distinguish green from non-green, partly because of the way it was defined, partly because item 6, that's how you're going to get new favorable financing. And to do all of that, you're going to need a few things. You're going to need a chief health officer. You're going to need a chief privacy officer. Sooner or later, the politicians will figure out that there should be a Health Reinvestment Act imposed on every employer because the employers are the natural place to put it. It'll be the employers and the MCOs, the managed care organizations. And so that brings us to the end of our story. I think that over the next 6 to 18 months, we are going to invent and then put into place health secure housing as a reality. It'll probably be called healthy housing by the time we're done. The whole discussion in the first panel about the economics will work itself all out. It'll work itself out by changing the operating expense budget and by substantial concessionary capital that is provided for the capital retrofit necessary for the properties. And I say that off of watching asbestos and radon and lead-based paint and all of this kind of stuff happen before. I'm trying to make sure that when the next gazillion dollars go out, that funding for this kind of stuff will happen as part of that whole package, because the faster we do that, the faster lives get saved, people get protected, the poor people get less excluded, their education, their economy, their earning power revives. And the faster this happens, the faster America gets better. And I don't know whether they all want to leave or take questions.
Thanks, David. Compelling as always. In terms of Q&A, we would like to transition the Q&A over to the reception. I have a couple of quick instructions first, and you will be able to change your breakout if you need to, because you have a burning question, and we'll copy over all the questions from the chat over to David too. But thank you very much.